I want to thank you for being here, and thanks to those from the public who have joined us in the room or via our webcast to listen to this important discussion. And as the room seems to be full, we want to also mention that it is being webcast in our auditorium. If people were to come in and there was no seats, they can have a seat in the auditorium, and this event will be webcast there also. Investments in the private equity industry, and in particular the fees paid to private equity managers, have gained considerable attention from regulators, observers in the financial markets, academics, and in the media. There has also been keen interest and a number of questions from our own board members about the benefits from investing in the asset class and the drawbacks that are inherent in the industry and commonly accepted. Today's workshop has been designed to give us all a greater understanding of the role of private equity in our portfolio, some history about our private equity program, and the fundamental terms and conditions that come with being an investor in this asset class. Our investment staff has spent the last 2 months preparing for this workshop, and the industry experts invited here today have spent considerable amount of time developing their presentation materials. We have a lot to cover in a very short period of time, and I'd like to outline a few ground rules in order to assist in that endeavor. To help ensure that we get through all the materials before us, please hold your questions until the end of each panel. We will have about 15 to 20 minutes available for questions at each interval. So that I can clearly see that you have a question, because I can't see the red lights on your speakers, I'm going to ask that you put your name up like this, and I'll know that you have a question. To be concise please be concise with your questions. We are not being asked to make decisions, and we will not be discussing specific funds or transactions. This time will be used to strengthen our understanding of the asset class and to inform future discussions and decisions around private equity. And finally, be respectful of the time and effort that our staff has put into this workshop, and to extend to them your attention and professionalism. At the conclusion of the workshop, we will use the time for additional questions and, of course, any public comments from the audience. And I've asked Mr. Slayton to work with me on the time element, because we do have a long presentation and we do have additional business to conduct after this workshop later this afternoon. So we're going to be very diligent about the time dedicated to this workshop. So with that, I will now call on our Chief Investment Officer, Mr. Ted Aliopoulos, to offer his opening remarks and to give us a brief overview of the agenda. Ted?
Terrific. Good morning. Thank you, Henry. Good morning, committee members. Good morning, everyone in the room today. As Henry mentioned, we do have a lot of materials to cover, so I will keep my remarks brief. I'd like to start off by just offering my sincere thanks and appreciation to our investment staff, to our legal staff, to facilities and technical logistics staff that have helped us put on this workshop, as well as the esteemed experts that we've assembled here today in person or via audio link for the tremendous amount of work they've all collectively put in to make today as informative and productive as possible. We are confident that the agenda that you have before you today is comprehensive and thorough, and we hope that it will better inform the committee's understanding of this asset class, the industry as a whole, and our role, CalPERS, as an investor in this asset class. We have 5 topics, main areas that we plan to cover. You can see them here briefly, and for each of these 5 topics, we have assembled a different panel presentation to present each of these topics. So you'll see me coordinating and calling people up to take up each topic and introducing the panelists. There certainly has been much discussion in recent months, as Henry alluded to, among policymakers, investors, and in the media about the need for change in the fundamental terms and conditions of private equity investment agreements, and rightly so. As you will learn from today, reform of the industry is ongoing and is sorely needed. The fees are too high. The fee structures are too complex and not transparent enough to the investors. There are internally to the structure of these agreements misalignments of interests that are tolerated in the structure of the limited partner agreements, and reform is needed to correct these imbalances. But as I've said before, it's important that we don't let this recent attention and discussion eclipse the work that CalPERS and other investors have done in this asset class over the years and continuing to date and into the future, our collective commitment to financial transparency and reporting. In that regard, the industry is on the brink of some dramatic improvements in reporting and transparency, and we'll hear more about that in panels to come. The other point that I'd like to make is that we can't lose sight of the very big picture, which is the need to deliver the 7.5% return objective you have set for us. The investment office is charged with delivering that 7.5% return under the risk parameters that you've set for us. Our beneficiaries are counting on us to keep an eye on that priority, to deliver a 7.5% required rate of return for this fund. Before I turn it over to Eric to get us started on the first panel, I wanted to introduce some of the key characteristics of private equity and some of the key topics that we'll be covering in today's panel. Turning to this key characteristics slide that your entire senior investment team put this slide together. And it highlights what we've discussed in prior meetings. There's a tension within private equity between the pros and cons, the benefits and challenges as we've articulated it on this slide, the good and the bad in choosing to include private equity in our portfolio. And this slide down the center of the slide shows some of these key characteristics of return, risk, long-term investor and time horizon, cost, and complexity. And you can see the good and the bad arrayed on either side and the tension that it causes in making judgments around whether to invest in this asset class and how to invest in this asset class. Certainly on the benefit side, the higher return profile of private equity amongst all of our asset classes, but also in particularly the higher return profile on a net basis versus our global equity portfolio is a benefit. The investable universe that the multi-trillion-dollar industry of private equity represents is an important concept to consider, especially if one were to consider divesting or not investing in a universe of that size that's available to investors throughout the globe. On the other side, on the challenge, as we'll see in these panel discussions, there's wide dispersion of return amongst the external managers that we do business with and other investors invest with. The funds are blind pools. When you go into them, you don't know the investments that will be made subsequently by your external manager in these areas. So it's hard to predict the characteristic and nature of the return streams that you'll be receiving. Manager selection and the persistence of manager performance over time absolutely drives the performance of this asset class, and it's a challenge, and we'll hear from our panelists on this topic as well. Risk. Well, one benefit is that less correlation to other asset classes within our portfolio, and particularly with global equity, but this is a controversial topic because as you look at on the challenge side, as we've discussed many times, the infrequent nature and the estimations involved with private equity call into question the benefits of correlation for private equity. Benchmark for private equity is a real challenge. Difficult to identify and select a benchmark to compare against private equity, and that's certainly a drawback. One would think in terms of a long-term investment horizon that private equity would be a maybe unmitigated benefit for an investor, but it comes with many challenges for how to execute that strategy for an investor. Very difficult to control your exposure, so very difficult to target a 10% allocation to private equity in your portfolio and keep that 10% constant over time. If you want to sell and exit your stake in private equity funds, the secondary market is very expensive. The investment timing is often dependent on the fundraising cycle of the external manager, not our own internal desire whether to access a market at a given time. We're handicapped by the cycle of a manager showing up to raise their next fund, and that is certainly a negative. Cost, I've mentioned it before, it's our highest cost asset class. But it's not just the cost that makes private equity such a challenge. It's the complexity and transparency of the fees that are part of the legal agreement structure that we'll hear about in panels to come. Complexity. There is some benefit, a benefit, that we talk about control investors. This is talking about the control that our general partner has in controlling a portfolio company. So there's advantages to be had by an investor having that sort of ownership control over a private company. But it comes with much complexity, as we'll see, in terms of the types of skills your investment staff needs in order to select these managers, to structure these agreements, and to account for it. So the returns and risks of private equity are a tension and a challenge, and we'll be coming back to this chart at the very end of the presentation to see how we think about the topics and the challenges that we've laid out. Quickly, I also wanted to just assure the committee that many of the key topics that we've discussed from time to time over the last 6 to 7 months will be covered today. Risk in many different incarnations are covered throughout the topics that we'll be discussing today. Benchmarking will be discussed. Alignment of interest and conflicts of interest and self-dealing by general partners and its relation to the interest of limited partners will be thoroughly covered. Topics such as management fee waivers, fee offsets, portfolio company fees, transparency will be covered throughout the morning and into the afternoon. The economic consequences of these terms and conditions will be covered in quite some detail in panel 4. And finally, the topic of what is the sort of the net and gross return and burden within private equity will be covered. I mentioned that we've seen this discussion for the last 6, 7 months, but I don't want to leave the impression at all that these topics are at all new. They've been discussed, debated, analyzed for decades by CalPERS, its investment staff, its investment committee, as well as limited partners and institutional investors through forums such as ILPA, as well as educational forums that the investment staff has held for its private equity staff. I've literally gone through hundreds of documents looking at presentations at ILPA back into the 1990s on these very topics, as well as discussed it with the many industry experts that we have here today. And these topics of offsets and waivers and conflicts and transparency have been well known, well identified, and at the end of the day, for the past few decades, risks that investors have assumed in accessing this asset class. So today in this workshop, we hope we've designed a workshop to really comprehensively look at the big picture of the asset class within the portfolio, and then many of the very important details and risks associated with investing in private equity. And so with that, I will turn the agenda over to Eric Baggeson, if you can hand that, who needs no introduction for this group, but he is our head of asset allocation and risk management. He's joined by Andrew Junkin from Wilshire, again, who needs no introduction for our purposes, but for our audience is the general, Wilshire is the general consultant and independent fiduciary consultant for the Investment Committee on Investment Matters. And finally, we hope to link up via a video link with Professor Josh Lerner, who is the Harvard Business School Jacob H. Schiff Professor at the Harvard Business School. Dr. Lerner, among, just by way of introduction for the board, is a professor at the Harvard Business School, as I mentioned, and he founded the Private Capital Research Institute at Harvard, a nonprofit devoted to encouraging access to data and research about private equity and private and venture capital. He's one of the world's leading academics in the field of private equity research, and we're delighted that he was able to conform his schedule to be with us. Now we've hoped for our technological link to occur. I know he's making it to the room in Cambridge to do this, and we expect to have him linked up, if not now, in the very near future. And there we go. Wonderful. Good morning, Professor. Thank you for being with us today. So with that, Eric, I turn it over to you.
Good morning, everyone. As Ted said, I'm Eric Baggeson on CalPERS staff. In this section of the material on private equity, we really want to just touch upon quickly some of the reasons why private equity has been included in the overall asset allocation for CalPERS. This chart states the role that private equity plays in the overall portfolio. If you really distill this role down to its essence, it's to enhance the returns that we generate from equity investing, which means that we take basically an ownership position and an ownership risk, if you will, in companies. We do this obviously within the publicly traded segment of the CalPERS portfolio, and then private equity represents another branch of that same kind of exposure. The table on the bottom of page 7 reflects the capital market assumptions that were used at the most recent asset allocation analysis for CalPERS. This material was generated in 2013. Also put in here for reference are the current capital market assumptions from PCA and Wilshire Associates, two of the board's consultants, just to show that basically the assumptions that we use in including private equity in the asset allocation structure are not outliers. The numbers are not extreme in our judgment, basically. The next slide on page 8 gets into the return structure. And what you have are 5, 10, and 20-year returns of the major long-term asset classes that have been included in the CalPERS portfolio. So if you take a look, the left-hand bars represent the returns that have been generated, and these are net returns. These are not gross returns. Private equity has had the highest rate of return in both the 5, 10, and 20-year periods. One thing I would note about this chart, though, is that the horizontal line that represents the discount rate that Ted mentioned, the expected rate of return on the portfolio, 7.5%, did not actually scale correctly in the generation of this slide. That line is currently positioned at approximately an 8.5% level. That number, or that line, should be positioned just above that 7.2% bar, which is the next to the last bar on the right-hand side of the chart. What you see from this is that the asset segments on a long-term basis that have exceeded the 7.5% expected rate of return and discount rate The only areas that have exceeded that are private equity and the public equity portfolio when we look at this on a 20-year basis. I would point your attention, though, to the 10-year chart where you see the public equity number is 6.6%. So public equities actually underperformed that 7.5% assumed rate of return and desired rate of return by almost 100 basis points for the last 10 years. And all of this data is through June of this last year, so our most recent fiscal year. Another way to look at the returns is in terms of gross versus net results. For the private equity bar on the left-hand side of the chart, we're assuming this asset segment generates a return of approximately 19-odd%. We've used a 700 basis point cost estimate that is derived from the work of Ludovic Philippou from the University of Oxford. This gentleman's research has fairly extensively delved into the kinds of fees and charges that are attached to investing in private equity. So we're just assuming this number, even though is what you will find as we go through the material later on in today's session, that the actual results and the costs and the fee structure for CalPERS actual investment exposure in private equity is extremely variable, depending on the structure of the agreement, the kinds of returns that get generated, and there is no really standard fee that is attached to this industry. And the breadth of outcomes you will see in greater clarity later on. The other point that I would note is that the public asset classes for CalPERS are extremely inexpensive to manage. And in large measure, this derives from the fact that we do a tremendous amount of internal management. The slide on page 10 is another way of illustrating some of the benefit that we've extracted from investing in private equity over the years. The line chart shows the growth of the value of a dollar over a 20-year period. So you can see that a dollar invested into private equity in the net returns that have been generated for CalPERS has grown to over $10 in value. The next highest value is the global equity exposure that over 20 years, a dollar invested in that turned into $4.80. We've also tried to estimate the cumulative value of having invested in private equity. And there are two mechanisms that have been used to try to estimate that cumulative value. One is something called the public market equivalent, where all the cash flows that have gone into and out of private equity are assumed to have gone into or out of the actual CalPERS public equity portfolio. That calculation implies almost a $17 billion value added from having invested in private equity over the 20-year period. The other mechanism is a return difference calculation, where we simply look at the average assets invested in private equity, and we calculate the rate of return difference between the private equity return and the public equity return, and then just accumulate a dollar value of addition or subtraction depending on those relative returns. That calculation points to an approximate cumulative value of private equity investing of close to $12 billion. We think that's a fairly compelling reason as to the contribution that private equity has made to the overall CalPERS portfolio. Another aspect of private equity are the elements of diversification. The table on page 11 shows the capital market assumptions, and then it also shows the actual observed values. And again, this is calculated on a 20-year time period. What you see is that in our capital market assumptions, we assume a 25% volatility for private equity returns. What we've actually observed is approximately a 19% volatility. And that compares to the approximately 16% volatility that we've seen from the public equity portfolio. So private equity looks a bit more volatile than the public equity segment. I would also point your attention to the correlation. We've obtained a correlation from our private equity investing of just under 0.7, so it's a 0.69% correlation. The assumption that goes into the capital market assumptions are for a 0.73 correlation. So private equity has actually delivered a little bit more diversification than the assumptions that have been included in the overall asset liability management exercise. The next chart that we have for you on page 12 is another way of illustrating the effect of private equity. This is an efficient frontier that has been generated from the same material that we used in 2013 at the last asset liability management exercise conducted with the CalPERS Investment Committee and Board. What you see, the top line, is the efficient frontier with the inclusion of private equity. If we were to remove private equity as an investment alternative for the CalPERS portfolio, given the assumptions that we used in 2013, we would have had two potential different outcomes depending on what we were trying to achieve. If we attempted to maintain the same expected rate of return, which for the analysis done in 2013, the expected rate of return ended up being a 7.15. I'm going to call that a short-term return, even though that was estimated over a 10-year period. If we attempted to maintain that 7.15 rate of return without private equity, we would have had to increase our allocation to the public equity space by 20%, and that would have equated to an increase in the volatility expected, moving that up by over 94 basis points, or almost 1% additional volatility. The work that we've been recently doing with the CalPERS board on the whole issue and the impact of investment volatility, and this springs right into the risk mitigation work that's been being conducted by our CFO and our chief actuary, as well as Ted, and the damaging impact that that can have on employers and employees as far as contribution levels and contribution level volatility. So we would have consciously had to take on almost 100 basis points of additional volatility if we did not have private equity as an alternative in the portfolio. The other alternative would have been to try to maintain the same kind of expected volatility, and the expectation from the 2013 ALM work was that the portfolio would have 11.76% volatility. If we had done this without private equity, we would have had to allocate an additional 14% to the public equity portfolio, and that would have equated to a reduction in the expected return of 25 basis points. So that would have knocked us from a 7.15% expectation to a 6.9% expected rate of return. And it would have potentially jeopardized the ability to have the long-run 7.5% assumed rate of return. Now, there's a couple of things that we're doing in the asset allocation area in relation to trying to deal with some of the realities of private equity. One of the things that we're trying to work on pretty significantly is the ability to control the actual exposure that we have in the private equity segment. As Ted mentioned, that's a real challenge. This chart on page 14 of the material, the lines moving in a step function, if you will, across the page represent the target allocation that CalPERS has maintained to private equity. I would point your attention to the rapid increase that we had in the 2008-2009 time period, where the target allocation went from 6% up to 14%. In reality, those targets were being moved simply because the private equity portfolio was expanding in size as the public equity segment of the CalPERS portfolio sold off during the financial crisis. We were not able to simply reduce the exposure to private equity in that time period. But you can see the variance that has existed between the actual exposure, which is the jagged line moving across the page, and the targets that we have. And at the very right-hand side of that line, you see the interim asset allocation step, where we move from a target of 12% that came out of the ALM work to actually having a target allocation currently of 10% for private equity, which was the maximum allocation that we thought would be achievable in the relatively short-term time frame. And one of the ways of potentially controlling the exposure to private equity in the asset allocation is to try to find some kind of liquid alternatives. And certainly there's been a number of research pieces and academics that have basically encouraged or stated that they believe that private equity can be proxied simply by levering up a public equity portfolio. This chart shows the actual private equity experience that is the box in the upper left-hand quadrant of the chart. That's the actual experience that CalPERS has had, again, over a 20-year time period from its private equity investments. The origin of the chart, where the two axes cross, are the capital market assumptions used in the 2013 work. What we've done is we've also plotted CalPERS' public equity portfolio. Those are the triangle symbols. And we've used a small cap index, the Russell 2000, which is a domestic small cap equity index. That's the diamond symbols. So what you see is that the expected rate of return for an unlevered, either a public equity portfolio overall or even a small cap portfolio, does not reach the assumption on a return basis that we attach to private equity in the asset allocation exercise. If we attempted to lever up either our global equity portfolio or a small cap portfolio to be equivalent to the actual results that we've obtained from private equity, we would have to apply approximately 70% leverage to the public equity portfolio, which would also then serve to drive up the volatility of the public equity portfolio from the approximate 16% that we have seen in its reality. That would have driven up, that leverage would drive up that volatility to almost 27%. So that's almost 800 basis points higher than the 19% volatility that we've actually experienced from private equity. In the small cap space, if we were levering a small cap portfolio, we'd have to use about 50% leverage. That leverage in that benchmark would equate to approximately a 30% volatility. So that's almost 11% higher than the actual outcomes that we've had from private equity. And the correlation of these levered public equity indexes, we would assume would be significantly higher than the 0.69% correlation that we've obtained from the actual private equity portfolio. So we would potentially increase volatility dramatically while at the same time actually reducing some of the diversification benefit that we've received from private equity. So there are no obvious, simple answers to finding alternative ways of expressing the private equity exposure that gives us an easy mechanism to actually control this exposure in the overall asset allocation. So to move this along, we'll just hit on a couple of other elements on this. So there are two other challenges from an asset allocation perspective that we'll be working on. One is the benchmark work that Ted mentioned, and that'll be work that is brought before the investment committee during the springtime of next year when we continue on with the benchmark review. But we do think that there are significant challenges to the private equity benchmarks. The other area that we need to work on from an asset allocation perspective is in actually being able to forecast the cash flows attached to private equity, because the cash flow uncertainty is another element that creates some asset allocation challenges. And with that information, I would turn this over to Andrew Junkin to provide a little context as to how other institutional investors have exposure to the private equity segment.
Great. Thanks, Eric. Andrew Junkin with Wilshire Consulting. So what we've provided here is data from the Trust Universe Comparison Service. This is how other large institutional investors are using private equity. It is their actual investment. It's not the target. It's what they're reporting as of June 30. So starting on the left, you can see this bar is actually all plans. So this includes public retirement plans, corporate retirement plans, and endowments and foundations. So a very broad swath of institutional investors. You can see, if you look down in the data below the bar, there are 213 observations, so 213 different investors included in this universe. Really, the range of implementation levels is quite broad. You can see the maximum is 72%. The minimum is 0. People are making decisions on private equity as they should be. It's a decision that goes into your asset allocation, which should be based on your goals, your risk tolerances, and no two people should get to the same answer precisely. You can see the median here is about 7.5. As we move to the middle bar, now we're looking at large investors, it's still the same group. It's still foundations and endowments plus corporate plans plus public plans. You can see the spread has narrowed here. We're down to 50 observations. The maximum is about 35%. The minimum is still 0. The median is about 11%. And again, CalPERS is 10% across the board. And then the last group is large public plans, 10 billion and over. Now, there aren't as many here, which is why we've provided the other data points. There's 12 plans in the universe here. The highest allocation being 20, the lowest being 0, the median being 10. So this is an asset class that, by and large, investors are really utilizing to help drive returns. As Eric pointed out, that is really the entire goal of this asset class. It's to push returns into the total plan. Now, you do get some diversification benefits. It is a different universe of securities, obviously. There are some diversification benefits that come from the timing of the valuations. It's just the fact of the matter. We haven't solved that problem, but it does provide some benefit. So again, this is a very idiosyncratic decision that people are making for their specific portfolios, but you can see you're not very far from what other people have chosen to do in most cases.
With that, Professor Lerner, we're, if you can hear me, I think you can. We're turning over the presentation to you, and if you need me to direct to certain slides, just call it out for me, and I can help you with that.
Well, thank you so much. Can you hear me okay?
Yes. Sorry, Professor.
Yeah, that was considered the first panel.
Professor Lerner is part of the first panel.
Okay, thank you.
All right. Well, if we can just advance one slide. I want to, first of all, thank everyone for the invitation to come and apologize for not being there in person. I was shepherding through one of the tenure cases of one of our younger people today, so I just couldn't make it. Going to the next slide, I think I was already introduced, so I won't belabor the point, but it's worth highlighting that I've been doing research in private equity and venture capital for longer than I care to admit, for quite a while, and looked at a variety of different aspects of the industry. It's also fair to say, as these headlines suggest, some of the papers have been, putting the industry in a good light. Others have been raising questions around some of them, and as the headline suggests, they range from topics from, the consequences of private equity in terms of the companies in which they get financing, in terms of jobs and other measures, to issues around things from the perspective of limited partners and the kind of returns that they generate. Switching to the next slide, to slide 21, I thought I would highlight two key areas today in terms of what I would talk about. Obviously, there's a lot of really interesting stuff, and as a professor, I can go on for a long period of time around this subject, but I've limited myself to first the question around private equity performance briefly, and then diving in a little deeper and looking across the different classes of limited partners and what their performance is, and why, at least historically, we've seen such discrepancies. I've also left a little bit of stuff in the appendix around the interest that we see today across the industry in going it alone in terms of doing both co-investments and solo investments, and I'd be glad to discuss that topic if people are interested as we go along. And I'll aim for speaking for 15 or 20 minutes. Please, if there's things that raise questions and so forth, it's a little awkward not being there, but feel free to interrupt me and we can discuss it. So just jumping ahead to the performance measurement, and we can go one more slide to the first table. I think the experience that's been highlighted so far in terms of CalPERS is somewhat representative of what we see in terms of private equity performance more generally. This is from a paper by several professors, which was published last year in the Journal of Finance, where they used the same measure alluded to earlier, the notion of a public market equivalent. And just to review, the notion of a public market equivalent is that if it's bigger than 1, it means that the private equity has outperformed during that same period. If it's less than 1, it means to say that private equity has lagged. And when we look at just in broad brush, at the vintages of funds formed in the 1980s, during the 1990s and the 2000s, we see that, first of all, the typical PME has increased over time, whether we look at the average or the median, and that in particular across all three periods, but particularly over the last couple periods, we see that these are well north of 1, which is to say that if we take, for instance, the average PME during the 2000s, the 1.27, what that's saying is that for every dollar you would have made in terms of investing in public markets, you would have made $1.27 in terms of private markets. So certainly when we look at this, it's hard not to conclude that there has been a real outperformance on the part of private equity relative to the public markets. Going to the next slide, though, one of the things that's clear is that we have a lot of finance professors around, and we can always make things as complicated as we want. And in particular, there has been a number of concerns raised with that kind of basic PME calculation that I showed on the earlier slide that suggests that this is perhaps too simplistic a way to look at it. Certainly one concern that's already been hinted at is that private equity funds might be riskier than the typical public market company. And we know that one of the adages that we have is that if you have higher risk, you better have a higher return for it. There may, in fact, be variations in the risk, and that essentially the S&P 500 doesn't really capture everything that one needs to do. So there's been a variety of efforts in the last couple of years by academics to try to say, how can we really risk adjust this rather than just simply running a horse race between the public markets and the private markets? Let's really try to figure out what would be the comparable risky public market investment to compare to private equity. So, for instance, one notion is the idea of betas, to essentially say if we take the public markets and either choose riskier companies or take relatively low risk companies but leverage up and add a bunch more leverage so that the equity that remains is riskier, what do we see? Then there are some more sophisticated adjustments that Ulf Axelsson and his co-authors have done. But essentially, the bottom line when you look across this literature is that it seems that you still have outperformance. Once you do these adjustments, the outperformance is not quite as large as it was before, but it's still there. Moving to the last slide in this section, I would say that if we were to try to give a bottom line here, we'd say that, first of all, we've become a lot more sophisticated, that the kind of comparisons that were done 10 years ago were simply just a simple naive comparison of private equity versus public market returns. Today, we have much better data on the private equity returns, so we've moved beyond just one or two data sources into sort of much higher quality data sources for research. And we also have much better methodologies to look at and adjust those numbers. And while not every study shows exactly the same story, and when you look across, as I said, there's a lot of professors and everyone's got their own chosen methodology. But if you look across the broad brush of the studies that are out there, they would suggest that there's still outperformance, that the outperformance is less than you might think about if you just did a simple naive PME calculation without any kind of adjustments. But at the same time, it really asks the question of, is it really worth it? In other words, given all the effort that's done in terms of trying to create and implement a private equity portfolio, if you're just going to have an index fund and you're just going to end up getting the average returns, you're outperforming a little, but is it enough to make this really worthwhile? And this really brings us to the next slide, which is to bring us to the section of thinking about the differences across various limited partners. And in particular, one of the facts that's been established is that, by and large, not all limited partners are created equal. And in particular, when we look at a study that we did looking at returns of funds formed in the 1990s, what we saw is that the performance of endowments in particular did remarkably better than other investors. Public pensions held their own with funds of funds, insurers, and so forth. Corporate pensions that were lower and banks were even lower. But what was struck by was just simply the enormous disparity between the different limited partners in terms of how well they did. the next slide, you might think that one explanation for this pattern is it's all about access, right? So we know that, for instance, the Yale Endowment was a very early investor in funds like Bain Capital, like Kleiner Perkins. And as a result, they had a seat at the table and could reinvest with these really high-performing funds, fund after fund after fund. And certainly part of the historical differences that appeared did have to do with access, that essentially the endowments, having been earlier to the game, had a selection of a broader set of funds. But it also seemed clear that the quality of the decision-making process was significantly different as well. And in particular, we looked at this by looking at reinvestment decisions. If you think about how getting into a fund, if you haven't invested, it's very hard if you're trying to get into a hot fund. But when it comes to reinvestments, pretty much the first move that people make is to go back to their existing limited partners and ask them back into the fund before they open the door to new investors. So essentially, here's a situation where access is relatively less of an issue. And what we did is we said, for this set of funds where access isn't really that much of a problem, let's see how well the investors did in terms of picking who to reinvest with and who not to reinvest with. And what we found is, again, that the endowments made much better decisions, largely reinvesting with firms that subsequently, in funds that subsequently turned out to be winners, while rejecting the funds that ultimately ended up not being terribly successful. The contrast is most dramatic with the difference with corporate pension funds. If you look at the scenario with the corporate pension funds, it was actually the case that their funds that they chose to reinvest with actually did worse than the ones they chose not to reinvest with, which is pretty depressing, especially when you think about how much resources probably went into evaluating the decision. Turning to the next slide, though, we see that there seems to have been a real change with the decade of the 2000s, with the most recent decade. And in particular, when as I alluded to before, when we looked at the 1980s and especially the 1990s, we saw this big difference between endowments and other limited partners. When we look at the more recent period, it seems that endowment advantage seems to have largely disappeared. And when you look across the different kinds of LPs that are there, you don't really see any statistically significant differences in terms of the kinds of returns that they're enjoying. It seems that this pattern has, in some sense, disappeared. And if you ask, why is this? Turning to the next slide, if you think about the historical patterns, there were two things that led to investors who were the sort of super successful ones, endowments like our own or like Yale's endowment, at being so successful. One of which was a wide dispersion, that there was a big difference across groups. And secondly, there was a lot of persistence. So let's look at those two things in depth. So the next slide I have simply presents interquartile ranges, so the difference between the 25th and the 75th percentile for asset managers along a number of different asset classes, assuming you held them for an extended period of time. And what's surprising is that the interquartile range, difference between the top tier and lower tier manager, is surprisingly small for the public market managers. What seems to be going on is that while in any given quarter there's a lot of differences, if you look over a longer period of time, things tend to cancel each other out. And in particular, if you think about it, the guy investing in the China fund looked like a genius in late 2014. By the end of 2015, he doesn't look so smart. And similarly, the value guy and the growth guy, right? All these managers are going to be passing over, flipping around in a way which means that over a longer period of time, big differences end up scrunching together. When you get to the right end of the graph, to venture capital, private equity, as well as asset classes like natural resources, you see a much broader dispersion between the managers. Now, as you recall, this is from the 75th to the 25th percentiles. if we were to do it in the next chart, what I did is an exercise where I took all mature U.S. private equity funds and just lined them up from the worst fund to the best fund. And what you see is that while there's a big difference between the 25th and 75th percentile, if we were to go and look at the 20th to the 80th, or the 10th to the 90th, or even the 5th to the 95th, you see how that dispersion gets even more dramatic, right? This is a realm where, it's not surprising that everyone claims to be top quartile, because when you look at it, right, basically 75% and below is really quite unexciting, right? All the action is in that upper tail. Just switching to the next slide, I did a similar chart for European private equity, right? And we see a very similar kind of pattern where there really is this sort of long tail. So that's certainly been one fact, has been this sort of enormous disparity. So if you've got the right managers, you tend to do really well. The other pattern that we see historically is in the next slide, which is regarding the persistence of performance. And in particular, unlike in mutual funds, where typically if the academic work suggests that if a mutual fund manager beats the market one quarter, they're likely to be as likely as not to be above, below, or in between the next quarter. There's no real persistence in mutual fund management. In terms of private equity, there's a lot of stickiness. So in other words, if you're in the top third, if you look at the bottom right-hand corner of that chart, it suggests that your next fund is almost, instead of having a 1/3 chance of being in the top third, has almost a 50% chance of being in the top third. And similarly, if your current fund is in the bottom third, you again have almost a 50% chance of being in the bottom third. And I think these two patterns, the fact that we have such big differences across managers and that those differences tended to be very sticky, explains some of the success that the endowments historically had. That you could essentially go to the racetrack and bet one horse race after race after race, and more often than not, you'd be a winner in terms of the kinds of returns that you get. And if we go to the next slide, it suggests that if we look at the more recent academic work, we still see these big disparities between the top-tier managers and the not so top-tier managers, between the mediocre and the very successful. But what we also see is that this persistence, this stickiness in terms of the winners staying winners and the losers staying losers seems to be breaking down. And while again, there's a number of papers which show slightly different things, if you look at them in aggregate, what seems clear is that one has a lot less stickiness in terms of the performance today than went on before. And I think we can relate that to the patterns that we see today, that in a way, it's no longer one strategy that's most likely to be successful, but instead we're in a situation where it's no one class of investor or one strategy is likely to be dominant. So heading to the next slide, I'll just take the last two slides to highlight a few of the implications. I think, first of all, when we think about the literature on performance, what it suggests is that an index fund approach, or just simply going and buying the market in terms of private equity, is likely to do okay, but not really very exciting, right? That you're going to eke out a little bit better returns than the public markets, the literature would suggest. But it really begs the question of saying, given the amount of work and the complexity associated with managing a private equity portfolio, is it really worth doing it? And the answer would probably be no. What instead it suggests is that if one's going to have a private equity performance, probably it only really makes sense if one has some degree of outperformance, which is there. Now, the good news, I think, for CalPERS and for pension funds more generally is that unlike the situation in the 1980s and the 1990s, when it seemed that the endowments had all the mojo and that it was very difficult for anyone else to be able to replicate it, today we see top performers across all classes of limited partners. It's not the case that you just have to be an endowment to be successful. Rather, what I would argue that institutions need to do is to look at the characteristics of the organizations that are top performers in terms of private equity investing and try to emulate those aspects of it. And, based on some of the field work we've done, and this is just hopping to the final slide, the characteristics of top performing LPs, I would highlight 5 points that what we saw from our field work interviewing some of the top performing limited partners and what were the characteristics of their strategy. First of all, the presence of a clear strategy that everyone agreed to and which really matched well with the kind of strengths that the organization had. Secondly, a real effort to build a brand and to sell themselves as a limited partner. You might think that as a large endowment or a pension or sovereign wealth fund, that's irrelevant, that everyone will come knocking on your doors for funding. But we saw that the top performing LPs really worked at communicating why it was that they were special, what was more than money about what they're doing. The staff were clearly extremely important, and not only the experience as individuals, but also the cohesiveness as a team. Investment committees, again, the experience and the wisdom that they could bring was extremely important. In general, I think when we look at the characteristics of the most successful of the investment committees, we saw ones that didn't micromanage the investment teams, but were more, setting the broad strategies. And then finally, a process of self-examination, trying to say, as a team, let's look back at what we've done that was right. Let's look back at what we've done which was less successful, and let's learn from our mistakes and fine-tune it. So those are a few thoughts. Hopefully they're helpful, and I would be delighted to answer any kind of questions that people might want to have in terms of discussing these issues. Thank you.
Thank you very much, Professor, for your presentation. And we are going to move into the question and answer period at this time. And so we have a first question from Mr. Jelensik.
I actually have a number of questions, but the ones I want to ask first are really definitional, and then I'll defer my other questions to later. On page 8, where you, Eric, or slide 8, where you showed the returns from the various assets, were all of those calculated the same way? Are we looking at an apples to
Yes,
apples
those are all returns that have been calculated through the State Street analytics system, Mr. Jelensik.
Okay, and does State Street calculate all the assets the same way?
Yes.
Okay.
Time-weighted
I believe
returns.
that's true. Wiley could tell us if it's wrong.
Yeah, that's accurate. There are time-weighted returns calculated by State Street across all the asset classes there.
Okay, and then Dr. Lerner, on slide 23, where you gave the returns, are those all net numbers?
Yes. So these numbers are all net of fees paid and carry paid by the limited partners. What they're not net of is obviously the cost of running the program that the LP incurred. So this is essentially assuming that this is just simply dollars in and dollars out to the limited partner, not the internal cost of managing the program.
Okay, and then on slide 34, the persistence of performance, what time frame was covered by this data?
Right.
Says it was done in 05, I would guess it was earlier, and you've got the following slide that says this persistence is breaking down. So I was just wondering, what's the time frame?
Exactly. So this study was done, the Kaplan and Shore 05 paper, because they needed obviously to look at mature funds, was really focused on funds from the 70s, 80s, and 90s. So that was sort of the historical pattern. And that inspired a number of efforts by people to take it to European data and other asset classes like private equity real estate, where they found a similar kind of pattern that was there. But the more recent work by Harris, Kaplan, and their co-authors suggests that pattern seems to be breaking down if you look at the funds raised during this current century.
Okay, and then on the next slide, if I understand it correctly, only basically half of the top quartile funds remain above the median in their subsequent. Doesn't that essentially say it's a coin flip?
No, I'm sorry, just for correction, those are tercile, so the bottom, middle, and top third. So if you think about it, right, if there was no persistence in terms of performance, it would be the same number along that line. Every cell would be 33%, right? You'd be equal, if you were in the top third, it would be equally likely that you'd be in the bottom, middle, and top third. But instead, as you see, it's 48%. So that's basically saying that, in a way, put another way, you're essentially almost 50% more likely to end up a top tier fund again. It's 48% rather than the expected number if there was no persistence, which would be 33%.
Okay, but on the next slide, which is, maybe I hadn't made it clear, where the second bullet there, only 50% of the top quartile.
Right. Oh, yeah, I'm sorry, excuse me, I was answering the wrong question, right. So on slide 35, if you look at the more recent study, it basically is essentially a coin flip, right? That it seems that the there have been several studies done, and they're a little bit different, but they suggest that the persistence pattern is far weaker than it was historically. And as I suggested before, I think one of the reasons why we may see that it's no longer one class of strategy that seems to be succeeding is because that persistence seems to be breaking down.
Okay, and I'll defer other questions.
Okay, thank you. Ms. Mather.
Thank you, and thank you, Professor Lerner. My question is really around the performance in page 27, slide 27 and beyond. You've broken out LPs by type. And again, you noted that this is earlier in the evolution of private equity, 91 to 98. But did you account at all for size and to what degree each of these categories include venture and how much that might be driving returns?
That's a great question. So when we looked at the data, what we found is that there was, if you looked at venture, there was a great deal of difference between the endowments and everyone else. But it was also true if you looked at the lower middle market and middle market private equity buyout funds as well. The only place where that difference disappeared was with the large buyout funds, which I think is probably in some sense not surprising, that given that there's a relatively small number of those funds, the returns from picking the right ones have probably been somewhat less.
So then, do you think the size of an investor's portfolio or an LP's portfolio vis-a-vis the size of the market as a whole, the capacity of the market as a whole, do you think that has changed over time and is impacting this persistence of performance?
Well, I think that may be part of the story, right? Because certainly one of the things that we do know about private equity, which has been shown in a number of research papers, is that one of the surest ways to just if you've got good returns, to destroy those good returns is to raise a lot bigger fund than your last fund was, right? That there seems to be, by and large, a relationship that when you grow your fund dramatically, your returns deteriorate. There's some sort of what the economists like to call regression to the mean that takes place, where that it becomes hard to sustain that top tier performance. So certainly one of the reasons why persistence may have broken down over the last 15 years is because in a world where it's been quite easy to go out and raise money, the groups that have availed themselves of it, by and large, have suffered. They've been able to raise the money and suffered a deterioration of returns as a result.
Thank you.
Yeah, thank you, Professor. On the outperformance by the endowments that you indicated in your data, and you also indicated what some best practices are in terms of selecting managers. But I'm almost sure that we use the same process that endowments use in terms of the information that you provided. So what other activities or information that allows for the endowment to continue to outperform or pick the best managers? Or is there any additional information that they're using or they're seeking less risk than we normally would? What are some of the other elements that continuously allow the endowments to pick the best performers?
I think it's a great question, and if I really knew the answer to that, I would put it in a bottle and sprinkle it around wherever I went, and it would be great. But obviously, what is clear is that the hard information, the return numbers, the attribution analysis to the individual investors and so forth, that almost every limited partner around the world uses is the same. What seems to have characterized the most successful of the limited partners is more the soft information. Somehow, it's never, I view it as it's never a totally clear decision whether to reinvest or to choose to invest with a private equity group. There's always some things that are likable and other aspects that are more problematic. And what it seems these investors have been able to do, the most successful ones, is to sort of have this almost intuitive or artistic sense of where is the cases where you've got some deleterious information that's a deal breaker, and where is the case that you've got something that's problematic, but the basic story is one which is so powerful and so convincing, we ought to go ahead and make that decision. And as I said, it is challenging to point to any one thing that characterizes the most successful of the endowments, the most successful sovereign wealth funds, and the most successful pension funds. But I think having a team that works together where there's a sort of broad consensus among both the investment team and the committee which is overseeing them, the investment committee, that they're in alignment as to what their strategy is certainly a crucial aspect of that secret sauce. But I think it's a great question and a very deep one that doesn't have a very easy answer to it.
Okay, thank you. My next question is for Eric. Eric, when I think it was page 19 where you talked about the 10% allocation, and when we adopt our targeted allocation, we also provide for ranges above and below those targets. So does ranges come into play at all in the data that you showed us? But when we move from 12 to 10, how, if ranges come into play in those calculations?
Yes, is this page 14, the chart that you're looking at, Mr. Jones?
Let me see. I think it was 19. Just a second.
I think.
Yes, that's it.
Yeah, basically. This does not show the ranges around that. And actually, the ranges around private equity have also varied over the years, basically, depending on the actual outcome that has happened in the portfolio. So the target allocation ranges are probably as much a facet of where private equity has migrated to as far as the exposure in the CalPERS portfolio as it is by intent to some extent. So the ranges have been, it's partly a deterministic calculation based on the reality of trying to actually, what allocation is achievable in the portfolio. But the ranges provide some room basically for drift before we, in essence, would have to come back to the investment committee and potentially make some kind of a decision. But truthfully, the decisions that we have made in the past have always been basically to just live with the actual exposure that has been there, in contrast to attempting to try to force any kind of a transaction, either to buy private equity or to sell it, that would force it back into the range.
The largest factor in terms of the allocation is driven by what happens to the other asset classes, particularly public equity. So if public equity does very poorly or very badly, that will dominate the percentage allocation in the total portfolio. And for historical purposes, I think it's important to underscore that there was a time when the board really did try to chase allocations, and that was in 05, 06, 07, and enormous amounts of money were put into the asset class at probably the worst possible time because the public markets were rallying and there was a desire to be at a certain allocation. that proved to be quite unfortunate, and I think a great lesson about being consistent and pacing was learned from that experience.
Professor Lerner, has there been any studies done on how much of the private equity world actually reports their returns? I mean, because otherwise you kind of wind up with a survivor bias, and and if I don't have to report my returns and they're lousy, I don't report them, but that kind of weights the average. Right.
No, I think this is a great question and raises a bunch of issues. I alluded to early on how much of the early work was done using the Thomson Reuters data, and one of the critiques that's been offered of the studies which used many of the early studies which used the Thomson Reuters data is that much of that data was self-reported by the general partners to them. And as you can imagine, that led to a situation where when things went south, people would stop reporting. I still remember a private equity conference where your former colleague Rick Hayes was speaking and asked people to raise their hand if they had reported their data to Thomson in 1999, and a large number of people raised their hands, and then he asked them whether they'd reported their data in 2002, and there was a substantially lower number of hands that went up, which not surprisingly illustrates exactly the kind of concern you've had. One of the ways, since then there's been a lot of progress in terms of research, and much of the research that has been done has been using databases that are not gathered from the general partners, but rather gathered from the limited partners. So, for instance, when you look at the slide that I began with in terms of the relative performance in terms of public versus private markets, that was taken from a series of studies using data from Burgess, which essentially is compiling the information directly from the limited partners themselves, right? So as long as the limited partners are capturing the universe of funds in which they're investing in, one essentially has a view that's devoid of any kind of selection bias in terms of what's taking place. But I think that one of the concerns we still have is that you have a series of databases, a number of which are certainly much better than the historical ones, but none of which are perfect. And you do see discrepancies across the different databases and numbers that are reported. Not to engage in self-promotion, but one of the real goals that we have in this nonprofit, the Private Capital Research Institute that Kaufman and Smith Richardson Foundations have supported, is the idea of trying to create a very high-quality academic database so we can have as good as it gets, at least, in terms of really capturing this area. I think we are further along than we were historically, but we certainly still have some ways to go until we feel we've really captured the universe of what's going on in terms of private equity performance.
When you talked about all the GPs trying to claim to be in the top quartile, right, and they all are depending on how they define their universe. Right. It reminded me of when I was setting up our futures program. Everybody was number one, and it turned out that the exchanges actually captured that data, and it wasn't easy to get, but you could get it. Right. Is there anything out there that really is going to try and capture all of the data so everybody who says they're first quartile actually we can show that they are or not?
I think it's fair to say that we're not there yet. That I think if you look at the quality of the database effort that, for instance, Burgess has done, if you look at what State Street has done with capturing their information, I think when you look on the nonprofit side, what we're doing with the Private Capital Research Institute, I think it's fair to say that the quality of databases which are out there today relative to what academics had to use 10 or 15 years ago are substantially better. But I think if what we're really looking for is perfection, which really captures it, we may eventually get there if there's enough, enough timely disclosure in SEC filings and the like. But today we're certainly not really there yet.
So to some extent, we're counting on LPs giving the academic community the data to help us.
Right. Well, I mean, certainly it's fair to say that, most of the research that I've done, for instance, we recently finished up a paper looking at direct investments, where large institutions bypass private equity funds and just invested in deals themselves. That kind of research can only really be done with the cooperation of the limited partner community. I think that's fair.
Thank you.
Okay, thank you, Professor Lerner. And Ted, do you want to move on to the next panel?
I think we should move.
Chairman, is it appropriate to take public comment? We will take public comments at the end of the workshop.
I don't mean to belabor this point, but under the Bagley-Keene Act, you're required to give public comment on each agenda item at the end of the agenda item.
Mr. Jacobs, would you comment on that, please?
I'm not aware of that rule. The agenda item that we're talking about here is the general agenda item. It's the whole agenda item, so I think we're okay.
Okay, thank you. Thank you. We're not, sir, we're not going to argue about this. Our counsel said that we are all right with this, and I said we will take comments at the end of the agenda. So if you would like to sign up, please make sure you give the person over here your request to speak, if this is not you that have already done so. Okay, Mr.
Sure, Mr. Chair. So thank you, Professor Lerner. Thank you so much for joining us. We'll move on to our panel number 2. You're certainly welcome to stay as long as as you'd like, Professor, but I know you have some commitments. For panel, I think that was him on his side. So panel number 2, Réal Desrochers, Alan Emkin will be kicking off the panel, and we're being joined, as you can see to my left, by 2 very distinguished and esteemed colleagues. Bob's looking for where they are. To the far left, right? No, I truly am really appreciative of Bob Maynard, the Chief Investment Officer of the Public Employee Retirement System of Idaho, who's served in that position since 1992, and one of really the as I said, esteemed and respected CIOs within the United States, and very, very appreciative of you coming out here, Bob, to join us. I know you had some difficulties with the plane ride last night, so thank you for coming this morning. And also esteemed and respected, we're very lucky in Sacramento to have Chris Ailman, the Chief Investment Officer of CalPERS, also one of the most respected CIOs within the U.S. and public plan universe, as well as globally. So, Chris, thanks for coming across the river and joining us here today. So with that, why don't I turn it over to Réal Desrochers, who's going to start us off. Now turning to looking at, okay, assuming you've made a decision to consider putting private equity in your portfolio, what does that marketplace look like, and how does an institutional investor access it?
Thank you very much, Ted. Réal Desrochers, CalPERS staff. What I would like to go is to go through a few slides to show the size of the private equity market compared to the global equity. And I'm going to tell you, CalPERS, even though it's a large investor, is small. Then we're going to go, who are the player in the private equity? On the first slide, what we have here is we look at it in 2014. We see that it's in $1 trillion. If you look 2013, 3.9, say $4 trillion compared to the total equity market of $69 trillion. That's a big industry. But what I want to point out also is that this is a premium economic industry. If you go back to 2005, the industry was $1.2 trillion. So if you look at that compared to 2014, it's 4 times the size. And if global equity would have grown as fast, it would be 160. So it's an industry that is, with premium economic, is growing very fast in terms of demand from the investors. On slide 41, what we have done here is looking at Private Equity International, which is a publication that look at the top 50 investors in private equity. We see in there that CalPERS is ranking number 7 in terms and represent approximately 1% of the market. Castor is number 11 at 0.7%. And the other point which is interesting, you see that the largest one is CPP at 1.9%. Point to be made also here is that there is a lot of newcomer in the industry, what we call sovereign wealth fund, people that will come in that they are either oil money or new money, big sovereign wealth fund that are coming in the industry, I would say over the last 5-6 years, that are not disclosing their allocation. So the point we wanted to make also is the number of overlap. You have that on the column there. CPP, I don't know if you see, 54 funds. What are these people looking to invest with the same manager as we have? So there's an intense competition. That's an important point. On slide 42, this is CalPERS experience, and there again we went to 2002 to 2015, and CalPERS represent at the highest was 2007 with 2.8% of the industry in that years. Adam Emken was mentioning that a while ago that this was probably chasing target at the wrong time in the industry. So I just wanted to show that CalPERS, important investors, small part of the industry. On page 43, how does CalPERS invest in private equity? So that's what we want to show. There's fund of fund, co-invest, and customized investment account. So CalPERS is investing in commingled fund. It's 90% of yours. We execute the strategy investing with 90% of fund. So on page 44, what does that tell us? So it's a matter of supply and demand of product. There is enormous amount of demand for what we call better performing manager. You heard that from Ted. I think that the top performing managers are very much in demand. Intense competition to get there. We heard also from Professor Leonard, is persistence there or is not there? So we have a very rigorous due diligence process, manager assessment tool, looking at who should we be investing with. I wanted to give you an example of a fund that we committed. That we committed to. It's a $10 billion fund. It's based in California. The people, CalPERS has invested with 6 prior funds. The team, which is we've considered very good, decided to cap their fund. We say cap. They limited. They had excess demand. They sold their fund in a few months with a $10 billion allocation. I think that's a good indication. We decided to commit there. We were scaled back. CalPERS was scaled back by hundreds of millions of dollars. This is a good indication also of the manager that they are disciplined. It's an option. We thought it's a good risk, but that gives you an indication of the market, what we see. Big market, growing market, CalPERS being about 1% of the market, cannot dictate term. We insist on working with the LPA, getting transparency. With the new PERS system that we have, also getting the information that we need on fee, carried interest, and all of that. So I wanted to give you a lay of the land on the investment that we are investing with.
Great. That's a good transition now to Alan Emken's going to kick off a kind of a moderated discussion with our CIO guests as well as branching out to the committee as well.
Thanks, Ted. I think it's much more important to listen to my 2 friends to my left, but just a little bit of context and background. The concerns about the need for this industry to be more investor-friendly is nothing new. Literally from the time it started, which was in the late 70s, the general partner had the dominant role in the negotiations, and the limited partners had a choice. They could either sign the documents or walk away. The world has changed. It's still far, far, far from perfect, and all of the recent controversy, all the recent disclosures, evidence there's need for far more change in the industry. This exhibit basically gives you a sense of the history of the Institutional Limited Partner Association, an organization designed to represent those people who literally, as individuals, have to negotiate with these highly sophisticated, highly compensated, very highly motivated organizations which want their money. And it's just very important to recognize that. The design of the organization was a reflection of the need for limited partners to work together to improve the marketplace from their perspective. And there's documents that indicate that there's a lot of history of this. You go back to 1996, Mercer did a study. In fact, there were subsequent studies that pointed out the problem with alignment of interest, the problem with fees, and that the industry was challenged. The two gentlemen to my left are known for their candor, their integrity, and their honesty. Not their good looks.
Candor, integrity, and honesty to the left.
Not their good looks. I'm sorry, Chris. And, you know, conflicts need to be disclosed. I work for Mr. Ellman. I don't work for Mr. Maynard, although I consider him a friend for more years than I would like to remember.
Since the late 80s.
Since the late 80s, when he worked for the Alaska Fund and I did a project for the Alaska Permanent.
Alan's knee.
That's it. But I have a few questions for them, and then hopefully that will generate some questions from you, because I'm really not the center of this one, unfortunately. The first question is, just give a real brief description of your fund and the percentage in private equity.
I'm at the opposite end of the spectrum here from you guys. I'm a $15 billion fund. We have $1 billion in private equity actually invested. We try to keep it around 7.5%, although we do not consider it a separate asset class to rebalance to. We're more, I won't say opportunistic. We've been doing it since 1991. The first investment was actually the month before I got to that fund, and my experience is probably going to be at the opposite end of the spectrum from yours. Although I will note, looking at Rial's latest thing, that you're getting to be my world, where it's called Groucho Marx type investing. Any limited partner who will agree to my terms, I don't want to invest with. The ones that I do want to invest in, they won't agree to my terms. So,
CalPERS, which is right across the river, the tall building, you can look over to us. 185 billion. We have 13% is our target for private equity. Currently, we're at about 10%, so just under 20 billion in private equity. We started in the area in 1989. My comments will also touch on the state of Washington. Many of you may not know I was the CIO for the state of Washington for a number of years in the 90s. Private equity is the largest, well, not the largest segment. It is critical to their portfolio. They are one of the largest allocators to private equity. I think right now it's close to probably 25% into private equity. It's been a key part of their program. Both Oregon and Washington were earlier investors in private equity than either PERS or STIRS. They've both been in the asset class since the early 80s.
And since I work for both of those funds, I can say that they both continue to heavily allocate to private equity, and that's literally why they would argue their good performance is driven by their exposure to private equity. The next question is, what do you individually and your board see as the role of private equity in the portfolio?
We're, I think, more skeptical of private equity than many, and actually I've been quite surprised at the experience we've had, which has been dead solid on the average. Our time-weighted returns are almost exactly yours. That 1.34 above what you could put in the public markets is exactly our experience. So we've actually gotten average institutional experience, so it's worked out better than we were expecting. We knew we were entering an area where we would not have much influence over what we could do. In fact, we recognized, however, that we were going to get some pressure to look at local investments in the private side. We did know that our actuaries and accountants would accept the smoothing that the accounting would do. It may be phony happiness, but we just want to think we're happy, and those actually do have consequences for the actual contribution rates we are going to be able to put in place. So we're looking for it, even if it just gave public market returns, we'd be in favor of it because it has some smoothing effects on both reported and actual risk as seen that way. Once you get into the area, this is kind of like a rental car return type investing. Once your front wheels are over the spikes, you can't back up. You got to keep kind of going forward. And if we're going to have a little bit, we've got to at least have enough to make it have a difference in the portfolio, which means get to at least 5 to 10%. And by the time we got to the 2000s, we had gotten to that point, so it did make an appropriate difference. So we're there. It's demonstrated benefits in the portfolio. We're happy if it gives public market returns, anything extra, because of its effect on having some smoothing of the risk as seen by the accountants and actuaries. And just don't, and you got to keep going once you're there, once you get an adequate amount in the portfolio, and now we're at that 7.5% level.
Yeah, in our case, Alan, it's absolutely is a return enhancement. I think we just are in the middle of completing our 2015 asset allocation study, and I believe, off the top of my head, we raised the correlation to 0.8 because we really, the diversification comes out of the fact that it's an appraised asset and that return is lagged a little bit. But I think we recognize that it's had a higher correlation to equities in the decade of the 2000s. And I would say the state of Washington, the same view. They look at it absolutely as just a return enhancement to their portfolio.
And it's just important to recognize when you look at return, you're looking at net return. You're not looking at gross return. Is that accurate?
Absolutely.
Absolutely, yeah. The way our benchmark is the Russell 3, but what we do is we've been doing the public market equivalent ever since we've been in it. Money, what would have happened if we'd have put that money in the Russell 3000 and then withdrawn it at the same point it comes back? And so that's a net return of the money going in, money going back. And
I didn't warn you on this one, but you have very different boards. I think the board of CalPERS is familiar with the board of CalSTRS. Could you describe your board, Bob?
My board is a 5-person board. 3 are business people who are high-level business people in the state. 2 are active state employees. They're all appointed by the governor, confirmed by the Senate, 5-year staggered terms. And we've had very little turnover. Jody Olson, many of you have known over the years. He's been chair since the 2nd year I got there, and he was on the board before I got there. And all of my board members have been on the board for at least 5 to 10 years, 10 years actually, except we just got our first new board appointment in 6 years, Celia Gould. And it's a very, when we work by consensus. For the most part. My board meetings are once a month, and we'll do an hour of investments whether we need to or not, 10 months a year. So it's mostly delegated down by consensus. Very rarely is there any our philosophy has been simple, transparent, focused, and patient, and so it's a pretty straightforward fund, so not much really comes up.
Obviously, as Alan said, most of my board. We have the treasurer and the controller in common, so we get to see both of them as you do. My board, I would always say the nuance between CalSTRS and CalPERS, our board has certainly the tilt toward education with active school teachers, K through 12 and community college on the board. State of Washington, I guess I would say, Alan, you could describe it better, a broader board, more employee representation. It is only the investment board. It does not cover the retirement system, so it is only investments. And it actually has representatives directly from the legislature that serve on that board.
And just for color, in Oregon, which is one of the boards that many people point to, with the exception of the state treasurer, they're all appointed by the governor, and they all come from the business community, and no one represents the employee community, with the exception that the executive director of the fund, the retirement fund, sits in an ex officio capacity. Very different politics, very different boards, but they've all reached a similar conclusion that there is a role for private equity in our portfolios for some of the same reasons that this fund has. Coming to that, though, if both of you would address what you view as the challenges of the asset class and the issue of benchmarks.
Rampant greed, actually, is the challenge of the asset class. I mean, the problem is that, you know, it's kind of like the recent settlements of the SEC. It was nickel grabbing unnecessarily. And so as a result, you know, the problem is that we're in a situation where we either play the game with the rules as established or we don't. And because of the advantages of the asset type, which I mentioned previously, we have preferred to play the game. I will say I'm on some other foundation boards of sufficient size, a university and other. On two of them, I voted against for them going in the asset type, and for one of them, the last month, I voted in favor of it. It really depends on the history, tradition, the ability to commit to it, and to deal with what are demonstrated problems that you've been seeing over the last number of months with the GPs and the fact that at different cycles, and we're just entering one now where you have less and less ability to drive the terms that are LP friendly. There's a number of provisions in those agreements that I'm still worried about. They're going to come up and kick us. I shudder to think what happens if the carried interest tax goes through, because there's a lot of provisions in these agreements that open some doors at that point. So as a result, there's that. By the way, us limited partners are no walk at the beach either, by the way. All of us are high maintenance our own way. I'm still upset at you guys for leaning on the general partners doing 2008, 2009 to slow down capital contributions. Plus, what you see as illegitimate industries and trying to force some of the general partners to get out of what my constituency would consider a constitutionally protected industry, it can cause problems because, in many ways, I'm glad you can't drive the terms of a number of ways because we have different constituencies that have different ideas. So all of these areas are extremely difficult and cause problems. I mean, and the issue you have is, and you've got to, if you're going to get into it in an area, you better put 5 to 10% to make a difference, and you better see those advantages on extra return, which I'm skeptical about, but the smoothing, but the ability to have an infrastructure to handle any local interests that may want to be reviewed. Those have outweighed and continue to outweigh the disadvantages that are clearly there.
From my perspective, the industry is evolving. You're obviously trying to push that evolution in many ways. So is our board. Many of the discussions you have had, our board has had as well. Josh Lerner gave you a very good picture of the history. Think about this industry in the 1980s, very small, very few funds investing in it. Information was key, and people got good access and got good returns. In the 90s, we saw the endowments do very well. A lot of that was driven by the technology bubble of TMT, and they had access to smaller funds that many of the larger funds could not get into with size. Now we've come through the 2000s, and we're seeing a lot more players in the marketplace. As Rial showed you in that slide, you're not the dominant player. We're not the dominant player at all. And so naturally, the advantage is being arbitraged away. And some of that return persistence, I think, where, as he said, the return persistence is dropping, and the dispersion of results is going to narrow a little, not widely, but we're already seeing the top performing funds, other than the few in Silicon Valley that find the unicorn, the most of the buyout funds that you have exposure to, and we do too, the returns are starting to show up as very similar, which means I think skill in picking managers actually is going to be tougher, not easier. It's not a flip of the coin. It's actually going to be harder. We've seen this asset class evolve over history. Funds that were large back when I started in this area were $1 billion. Now people are doing billion-dollar commitments to $20 billion funds. Transparency has always been a challenge, but I think we've looked at it from the LP perspective. Things like monitoring fees have adjusted over time. The latest issues, and like you, we support the SEC's review of this industry. We think it's welcome. It's unregulated. It historically is not registered. So it's good to see other people, but I think also LPs are much more active. We've been doing audits of GPs. Washington's been doing audits of GPs for years. I think that's a good, healthy practice. We're limited partners. We're business partners with them, but we have to keep them attentive. We have to be on top of them because obviously the information, the news stories that people have been breaking, I think Bob hit it well. GPs are by nature greedy and self-interested. We know that, and we understood that. It's not that LPs are being surprised. LPs want this information, and I think the biggest power you can exercise is through the industry associations, which we've been working with Ted on as well, but also through the advisory boards. You're big enough that you have a seat in most of your LP, the LP advisory board. Those boards now have the ability to meet without the GP in the room, and I think they need the ability to call a special audit to make the funds pay for an audit of those partnerships rather than you doing it or us doing it on our own. I think part of the challenge that we're all facing right now is that this industry is getting mixed up, obviously, with politics and the country and a broader issue. Rial had that good slide that showed you the size of the industry has gotten bigger. It's still minuscule relative to the public equity capital markets, but it's certainly, boy, it has gotten a lot more attention and a lot more media, and it is more shrill than anything anybody cares about in the public market. So I know we've devoted a lot of attention to it. Just like your evidence of doing the workshop today, you're spending a lot of time and attention to it. I think we deserve as much attention in the real estate industry, the infrastructure industry. That's just not as exciting.
And by the way, it is so much better than it was in the 90s. I mean, my skepticism is still high, but it's gone down. In fact, and I want to reemphasize too, I'm a big fan of ILPA. I mean, ILPA actually started as a reaction to, I forget, was it Bain or who was it that was Cheryl Pressler? Right. When she, there was some kerfuffle back in the mid-90s, and a number of the CIOs got very upset, Howard Bicker in particular. And as we started to look at trying to get together to do something, we were quietly visited by a number of the state attorney generals about antitrust law. So that's how ILPA got started. Instead, it was a creation of funds like ours that were concerned, and that has really advanced the transparency and the reporting. We will all disagree about what is categorized as a fee and what shouldn't be, but at least the effort to use a common format of reporting and common terminology is hugely important, and that has been the biggest breath of fresh air. It's not there yet, by the way, but it certainly has gotten better.
Mr. Chair, do you want to have some questions from the committee?
Yes, we'll go ahead and take the question. Mr. Jelenski.
A couple of things that were said. Bob, you said that you would do private equity even if the returns were comparable to the public market. I'd kind of like you to expand on that, because I did go to your website, and for the 3, 4, and 5 years, that typically was the case. They were slightly under the public market. But why would you do it in any case? And the other question I had was for Chris, and you may think about the correlation. You said you're using an 80% correlation. And I don't understand why it's not higher, since it's equity to equity. It's leverage, so that creates some volatility. And I think one of the things that may dampen that somewhat is the GP takes more when it's up than they take when it's down. But why the correlation?
A couple of reasons why, and I will expand on it. This idea that this is a riskier asset class, I think for many things is actually not true in the experience that we've all had for the last 20 years. First of all, my fund's in a much different position than yours. Our net return assumption is 7% nominal, but really what drives it instead is what really drives our returns is what is our real return, because if inflation's higher, salary's higher, we're going to have to pay out more, but if inflation is less and salaries are less, and we only need to make a 3.75% real return to meet statutory benefits. I mean, if 70% equities over 20 years doesn't get you 3.75%, the condition of the pension fund is not going to be the front page news because a comet's hit the earth. So as a result, getting a 5 to 6% public market return is what we need, which is still very doable, even with the pessimists like Alan given their views of the next 10, 15 years. Now, in that environment, Russell 3000 is good enough. And so the additional benefits, because the fact that, and we're not going to put 10, 15, 20% of our fund into private equity to try to hit a home run. We're comfortable with 7.5% because that way it maintains an infrastructure. When it does well, it does give a noticeable pop to the fund, and that. Again, the actuaries and accountants recognize the smoothing benefits of the appraisal process that are there. Now, they've been diminished because of GASB over the last number of years, but they're still there. And so as a result, it does soften the annual volatility of the fund, and it's that annual volatility that at the extremes drives our contribution rates, which are actual dollars in and out of our teachers and public employees' pockets. Now, as over the last number of years, you may have noticed that we just came through what was arguably one of the worst decades ever in terms of volatility. Everybody says it's also volatility, but every one of our volatility, risk and return volatility over the last periods of time, over the last 20 years, instead of being the expected 12 or 13% annualized volatility, our experienced volatility has actually been more like in the 9 to 10% range. And that is almost solely due to the private assets that have been recognized by the accountants and actuaries as legitimate for purposes of reporting. And I'll yell and scream about accountants and actuaries, but when they finally lay down the law and say, these are the rules you need to follow, here's what fees are, here's what your returns are, you kind of salute. So as a result, the private equity has outside then return benefits, and those are good enough so that even with public market returns, I'll be happy. I may just be thinking I'm happy, but like I said before, that's good enough for me.
Yeah, on correlation, JJ, I would say that in your model, I would assume is very similar to ours, whether it's 0.8, 0.9, or a full 1. The model's not going to care. It's going to treat it as if it's a highly correlated asset to your public equity portfolio. I can't recall where we used to be. I'm going to say 0.6, probably maybe 2 decades ago. So that's a big increase where before you thought there was some diversification benefit. What I'm saying is we've in essence ratcheted that up where we don't assume in the model there's any value from a diversification standpoint. And the reason that it's not 0.1 or 1.0 is simply, as Bob said, the timing of the returns, the fact that it's a more stable asset. You know, over 55% of your portfolio is changing in price every minute right now for no real good reason. And the people running those companies have about a 90-day perspective. When you think about it, and you've talked about it, CEOs care about quarterly earnings every 90 days. Private equity, real estate, infrastructure are the few parts of your portfolio that are at least long-term investments. And because you value them at best quarterly, but they really probably only change in price about once a year, and they're lagged, you end up with a slightly different return pattern. Your question about GPs taking more in stronger times, that should be showing up, number one, in your volatility, which we assume a much wider range of volatility in private equity than we do in public equity. And then it also should show up in terms of your expected result, what kind of a premium. I think if Josh Lerner looked back 2 decades ago, most people were expecting 500 basis points of added return or premium in private equity than in public equity. Most people have damped that down to at most 300 basis points in reaction to the fact that the industry has gotten broader, and therefore some of that return advantage has been arbitraged away. And that with the volatility patterns and the leverage, you're just not going to get as much extra return out of private equity than we have in the past. Even then, the model will still take as much private equity as it can get its hands on. You have to constrain private equity in your model just like we do. And if you talk to our friends that run endowments, Josh said he would, put it in a can and run around and sprinkle around the country. The big reason they have higher returns is the fact that they're nimble. They're very small. They have maybe $1 billion total, so they can allocate $250 million. They can take very discrete bite sizes, and we have a good friend, Colette Chilton, who interviewed, I think, for our funds at one point in the 80s, just to probably right. Yep. Colette runs Williams College, very nimble. Just reported in P&I outsized or outsourced returns in private equity, mostly due to venture capital, because they can get access to funds. Even if you could get access, it wouldn't move the needle in your portfolio. So you have to recognize, we call it the hierarchy of size in private equity. You, like us, are at the top where you're going to be overweighted to buyouts, like it or not. You can't manage your sub-portfolio allocation. And that makes a big driver of the return difference over the history of private equity.
And I'm even at our small size, we're barely your cash flow. We have the same issue. We only go with 20 relationships, mostly buyouts, who can handle the amounts of money we'll put. Plus, two, the venture capital people will never return my calls. Actually, I have a slightly different problem. I have noticed as well, however, the GPs are like squirrels saving for the winter. They tend to write down, but in up markets, they don't write the portfolio up quite as fast as the public market would indicate. And I actually have a complaint on the other side on that side.
I think we see that in the real estate portfolio as well. Real estate is forced to be more aggressive generally. We push them to write down faster in down markets, and they're slow to write up.
Okay, Mr. Land.
Thank you. I wanted to focus a little bit on this issue of negotiating terms of LPAs. You know, I spent about 4-decade career as a negotiator, and I hated when the other side had all the leverage. In reality, you gave this example of a situation where we had a high-performing investment manager, and you know, we chose to do the deal even though they would not go along with our proposed changes to the terms. I was wondering if you could give just a couple of examples and what some of those proposed changes were, and then conversely, there must be examples where we have not done deals because they would not change terms. And could you maybe give one of those examples?
Sure, happy to do it. On the case, on the case of, first we wanted to have a larger allocation up to the fund, that where we wanted to be. So the people, to their merit, I think it's good. They were disciplined to say no, because we would like to have CalPERS, who've been with us with the 6 previous fund. We would like to have, obviously, reduced carried interest, reduced fee, and this is, hey guys, you take it or leave it, because this is, they had so much money at the door. Why will they give us a rebate when they can get the money from some other people? Example of fund that we pass on quite a few funds. One that comes up to mind, I don't want to put the name here, but it's a, we always look at the, when we do the analysis, more than IRR times the money, distribution to paid in, and all of that. So we were looking at a fund that had, I think they were tripling their size, We look at the alignment of interest that we felt was not there in terms of their investment into the fund, and more importantly, when we look also in their due diligence, how much money do they charge to portfolio companies? No matter what, over the life of the fund that we were looking at, these guys would be billionaire, and we would be an LP. And we said, and they were reserving a $300 million allocation for us. That was 10% of their fund, which was oversubscribed also. And we just said, no, thank you. We have quite a few examples like that.
And then just a broader question for the group around, we saw this list of, I think it was the top 10 investors. We were number 7. And then, Bob referred to this issue about, well, it'd be great if we all just kind of got together and talked about, certain standards that we expect or minimum deal terms or whatever. But how do we get around this issue of antitrust stuff? I mean, what's kind of the nature of that? Is there potential for change? What has to happen? Where's that going?
Matt, maybe you can take the antitrust.
Hi, Ron. Unfortunately, there's not a lot of opportunity to get around that, and there's no proposal that I'm aware of that would alter the antitrust laws so that limited partners could more freely get together and dictate whatever they wanted to dictate. Having said that, though, it is permissible under the antitrust laws to do what ILPA is doing right now, which is to propose a template, particularly with respect to disclosure issues, and require or seek to require the GPs to follow those disclosure requirements. So that is one area that is permissible under the antitrust laws. It is probably permissible as well to go beyond that and talk about limited partnership agreements, forms of limited partnership agreements, standard kind of templates for LPAs. As long as you are not putting numbers, as long as you're leaving a large number of blanks, if you will, for the actual specific economic terms. So you would obviously leave carried interest blank, you would leave blank for management fees. There'd be a whole host of economic terms that would be blank, but nonetheless, some industry standard organization like ILPA could work on a template and could come up with specific clauses that address specific issues and try to move those forward as kind of the standard clause on this particular issue.
Okay, yeah, I have a quick question on ILPA. We've been working on this template for a long time, and I know that you're almost there, and eventually we're going to have this data where we're going to disclose all this information regarding the fees and the reimbursement disclosure, et cetera. And do you have a sense about when that would be released, Ted? And then to Bob and Chris, are you guys doing the same thing?
We'll be covering that in some of the later panels. January is the short answer for what, adoption by the LP and GP community in ILPA for the template, and we'll be taking a look at some of the specifics of or all of the specifics of the template then.
Okay.
We're going to be asking all of our general partners to report on the ILPA template. There is actually one out there right now, and what's coming out in January. And for our purposes, the current one actually is good enough for our purposes to determining whether or not distributions are there. The expanded one in January we're in support of too, although the issues that addresses are not as crucial to someone at my end of the PE spectrum.
Henry, I'll divide it in a couple of ways. One, a big issue that's been in the press a lot has been the portfolio monitoring fees. And I think most of your documents and your negotiations, just like ours, are pushing where those are 100% reimbursed to the partnership level. But that's where I think the audits of partnerships can help make sure there isn't any extra income going from a portfolio company around the partnership to the GP and just demanding disclosure. That's why the advisory boards need to be more empowered. Our board is been talking about that. We take we're looking at it in a holistic standpoint of what I would call netted fees. because you see incentive fees not only in private equity but also in real estate and in other asset classes. You also have netted fees. So think of your mutual funds. You have netted fees sometimes in your money market funds and other locations. We don't have an automated system to track that. I've talked to Ted about buying yours once it's up and running or buying a license. So it's all going to have to be done by hand. So we're coming back in February with a budget proposal to staff up a unit that would track netted fees. Our board at least wants to see that as part of the cost. You're in essence asking from the gross return number you publish now has many of those fees already netted out. So you're suddenly going to be publishing a gross return that's even bigger. You, like us, report net of all investment costs, which are already net of those. But I understand the desire to track all of those netted fees and understand what they are. We've had numerous debates about whether that'll cause those fees to constrain or not. I think Ted said at the beginning that the fees in private equity are too high. The fees in any industry are driven by the industry. I can argue that the fees for a knee replacement are too high, and I think you guys did some work on showing the transparency around the cost of a knee replacement. But I'm going to bet you that there are going to be some doctors that will do that darn cheap, and none of us would want them to touch our knees. But there are other doctors that are probably very expensive, maybe too expensive. Marketplace is going to be driven by market demands. And I think we're already seeing that with certainly some of the Silicon Valley funds. You're not in them, we're not in them because of a state law. And some of those fees charge 30 to 35% carry. But they've had some of the famous, as they describe, the unicorns that they've found in Silicon Valley. But the two California funds aren't exposed to those, which is sad. But it has a lot to do with that fee structure.
Yeah. One part of the history of this industry, too, by the way, is we all report. I don't control my CAFR requirements, my annual financial reports. That is controlled by actuaries and accountants. And for the 90s and 2000s, we all have different negotiated outcomes between our actuaries, our accountants, and the investment people as to what goes in the CAFR as a fee. So some say carry is a fee, many don't. We don't, for example, say it's a fee. We can net. We have a net fee that we report in the CAFR. Back in the 1990s and 2000s, there was a different treatment, and different accounting firms required different things. So to try now, one thing I don't want to see happen is your particular nomenclature for determining what are costs and expenses, try to make it nationwide, because all heck breaks loose between what has been a delicate balance that was worked out by people I don't control. And whatever they say, I'm fine with. But we all have different nomenclature and jargon as to what is a fee versus a profit share versus something else. And I don't think there's a huge consistency throughout the industry on that.
Okay, thank you very much. Now, Chris, were you going to say something else?
Oh, I'll just jump in that fire. Okay. You guys have been criticized, just like we've been criticized by some very small publications that are throwing dispersions at all of us. But lo and behold, I'm going to bet, and I'm a beneficiary. I get to vote for 2 of you members, so watch out. Your CAFR is, you probably have won the award from the Industry Association for years for the quality of your CAFR. You get an unqualified opinion, as do we. So we're reporting in line with industry standards and what is expected. What's changing is the evolution. And I'm sure you're talking to your auditors just like we're talking to ours about, is GASB going to bring this up? And if GASB changes the rules, we'll all report under GASB.
Okay, thank you for that part of the presentation. And Ted?
Well, I'd like to thank Bob and Chris. Thank you very much for coming and sharing with us today. Thank you so much.
Or in some cases, oversharing.
Not at all. I love the candor.
Yeah, thank you, Bill.
I think the rent-a-car will stick
yeah, right.
in our mind. So, Mr. Chair, this is so it's 12:15. The next panel is the legal agreements, looking at the structure of the limited partner agreements. I believe the presentation piece of that is 15 to 20 minutes. and then time for question and answer. So we had planned to take that up before lunch. We're at 12:15 now.
The recorder is not here, right? So we don't have the two-hour limitation, right? I don't see the recorder, right? Okay, so let's go forward, and we'll take lunch after the next presentation.
Thanks, Jim. You're here. You're still here for the whole time. So, Mr. Chair, on this panel number 3, we have Marte Castaños, the internal CalPERS investment attorney that principally oversees our private equity portfolio. And he is joined by Paul McCoy, a partner with the law firm of Morgan Lewis. We've worked with Paul on a number of the negotiations of our limited partnership agreements in private equity, and he's represented clients from across the spectrum and is a well-known attorney in this field. So with that, I'll turn it over to Marte and Paul.
Thank you very much, Ted. Again, Marte Castaños from the CalPERS Legal Office. We have a few objectives with this part of the presentation. We want to give you a sense of the dynamics of the negotiations. I think you've gotten a hint at what those are like, and that they're not easy, and they're tilted in favor of the GP. We want to give you a understanding of the common terms of a limited partnership agreement. Basic overview of those. We're going to spend more time talking about certain material, legal / business risks that have been highlighted by the SEC work, highlighted by critics of the private equity industry, and we want to make sure you have a full understanding of those business and legal risks. I'm joined by Paul McCoy. He's with the Morgan Lewis law firm. It's important to note that outside counsel does review every private equity legal agreement that we enter into. There is a thorough review with pre- and post-closing checklists. There are comment memos to staff that turn into comment memos to the general partners. Every deal is we attempt to negotiate terms on every deal, and Paul is one of a pool of outside counsel firms that helps us do that. Morgan Lewis does have a very large institutional investor practice. They represent 70 institutional investors, 18 U.S. public pension plans, including the 5 largest. They also represent sovereign wealth funds and fund of funds. So Paul and Morgan Lewis can give you the perspective of what CalPERS is negotiating for and what our process looks like, and compare that to other participants in the industry. And with that, I'll turn it over to Paul.
Thank you, Marte. Again, I'm Paul McCoy with Morgan Lewis. The first slide here I will go through quite quickly because based on the presentations preceding this one, it's clear to me that everybody in this room has a basic understanding of the way these funds are structured. But to never assume, they say. So, typically these are in partnerships. There's a general partner who has control, and there are limited partners that are passive in nature with limited liability. Those are the investors. These limited partnership interests are illiquid, and you generally do not have a right to redeem from the fund. There's also, in addition to the limited partnership agreements which govern the relationship between the general partner and the limited partners, frequently in the industry there will be side letters that address specific issues of any particular investor. You will hear a lot of talk about side letters in the industry. I think one thing that's very important to keep in mind with side letters is that a side letter between a general partner and a particular LP cannot change the terms vis-a-vis any other LP. It can't create obligations for other LPs, and it can't reduce the rights of other LPs. It's truly just a one-on-one arrangement. Because so many of these side letters are entered into, there's a term commonly included called a most favored nations provision. This term allows CalPERS, who frequently gets the most favored nations provision, to see and select terms from other limited partners' side letters. There are certain carve-outs to those, but that's the general nature of a most favored nations provision, and that's the general nature of side letters. There's no model limited partnership agreement. That was brought up by Matt as a potential sort of utopic version of how the industry might work. I say utopic because I think there are a lot of differing interests going into these funds. It's not just GP versus LP. There are a lot of different LPs of different sizes, of different agendas. You have foundations, you have small foundations, you have very large foundations, you have public plans, you have insurance companies, you have banks. All of these are different kinds of investors. And so they would all need to agree to a model LPA before even attempting to get the general partners who very much view their own businesses as separate and distinct businesses to agree to a model LPA. So I think there's some real hurdles to the idea of a model LPA, but I think it would be a fantastic, efficient result if ever achieved. There are some common terms, and we'll get to some of the differing terms and challenges, but some common terms among the LPAs include the length. They're typically 10 to 15 years in length. The interests are liquid, as I noted. The investors have limited liability with respect to every investment that CalPERS does that I'm aware of in private equity funds. They receive opinions of counsel to the fund that confirms that it is in fact a limited liability interest, so the exposure to CalPERS is protected. There are often LP protection rights. The three biggies are the right to terminate the fund, the right to remove the general partner and replace the general partner, and or the right to stop the investment activity. These sometimes come with a cause trigger and sometimes can be done with no fault, and it all has to do with voting thresholds, and negotiation over these is as you might imagine, quite intense. Every fund has basic similarities in terms of their economic arrangement. The specific numbers and deal terms might be different, but they have some form of profit sharing, generally speaking. They have often a preferred return such that the LPs will receive some portion or all, depending on the nature of the economic waterfall, of their money back before the general partner is allowed to share in profits. And they typically well, actually, before going too much further, I could just talk forever, as lawyers can. So that's the paradigm. I really want to just set the stage. That's the paradigm in which GPs and LPs interface and negotiate terms for specific funds. And so now Marte will talk about some of the challenges.
Thanks. As we hinted at in the previous presentation, it's very, we are typically investing again with better performing managers. So it is the common situation that we find ourselves in Fund 9, Fund 10. We've already been in Fund 8. We've been in Fund 9, and we agreed to those terms in the previous fundraising cycle of that general partner. So and now that general partner is back, and they're feeling good about themselves because they've had good returns, and their existing partners want in, and new partners want in. So we typically just get a black line from the last agreement. The GP may be asking for even more favorable terms. And then we will have sort of our standard side letters that we make sure we get fulfill any state law requirements. Transparency issues have driven negotiations for the last year around our side letter. We're hoping that ILPA will make this an industry, there'll be an industry-wide acceptance, and we won't have to negotiate on our own for our own rights related to transparency. So basically, what happens with these negotiations are, hey, you've agreed to this before. So we bring up term, you agreed to this last time. And we get that not only with regard to, hey, yeah, you agreed to it last time in this fund with this general partner, but it's a small industry. The big GPs have overlap in counsel and who represents them. They know what we've agreed to, and so it's very common that we ask for a term and they throw it back at us and say, well, you agreed to this before in this fund or this fund. So it's an uphill battle. the GPs in general use what I like to call a divide and conquer approach to negotiations. We're out on an island negotiating on our own. We know there are hundreds of other islands, or dozens at least, and there are negotiations going on in parallel, but we are unaware of the details of those negotiations, and the GPs like to keep it that way. So this I like to refer as the, hey, CalPERS, you're the only one asking for this. So you get that a lot. And we have situations where GPs close with less demanding LPs. We might not be in a first close, or they are structuring a process that encourages you to just agree. So you might have a situation where, hey, we'll give you a discounted management fee, but you need to be in on the first close, which is code for, we don't want to, see 50, 100 comments in your comment memo. Other dynamics, they may say, this is happening right now with a fund that has great performance. They've said, let us see your comment memo, and then we'll come back in 3-6 months or whatever it was, and then we'll tell you how much we might let you invest in our fund. So think very carefully about how, the length and breadth of your comment memo. And by the way, some of these investor friendly terms that we had last time aren't in the fund anymore. So those are a lot of the dynamics. Antitrust law has definitely come into play. There are major limitations on our ability to just set the terms with our partners. There are opportunities. We can share counsel, and where we do try to do that with other limited partners. You can have joint venturing agreements, but for different reasons, those haven't been utilized to any real degree to change the dynamics. A lot of that is the CIOs were very frank in their discussions. People tend to focus on the differences between the LPs and not their similarities. There's timing considerations. We don't necessarily want to wait a month for the other fund to get to where they are. We're done. We need to move on to the next fund. And all these LPs are trying to get money out the door and invest it. Every year, the private equity team needs to invest X billion dollars, and they're under pressure to meet those allocations. So those are all reasons why LPs maybe haven't come together as strongly as they could have been, as well as the antitrust laws.
Okay, so Marte noted some challenges. There are more. We'll get to those. Slide 50, nonetheless, talks a little bit about the legal review process at a macro level and some of the goals that we pursue in our legal review process. So Marte already mentioned that outside counsel with relevant experience, whether that's transactional tax or fiduciary or all of the above or some combination throughout a law firm, is engaged. Outside counsel working with CalPERS staff prepares a detailed comment memo, side letter, a closing risk memorandum to highlight risks. And the real goal of the legal review memo, as instructed, and so as outside counsel, we pursue, we zealously advocate for our clients, and so this is every bit determined by you what our goals are. But our goals, as instructed, are to confirm the fundamental business deal is reflected in the drafting, to identify risks, to meet CalPERS-specific legal requirements, many of those addressed in side letters, and then to advance the three principles that have been nicely framed by ILPA, which are alignment of interest, which is predominantly an economic concept, governance, which really I think of as LP protections, and transparency, which is primarily focused on being able to monitor the investment. Next slide, yeah. So there are a number of terms in the LPAs that are helpful, in fact, before we turn back to the challenges in achieving the alignment of interest, governance, and transparency. Carried interest, which is the profit sharing, Very simply means that if there's no profit, the GP doesn't get anything to share in, and the GP is incentivized, therefore, to create as much profit as possible and then get its share. Preferred returns create alignment by requiring that at least a minimum amount of return is created and returned to the LPs before the general partner can share in returns. Long-term investment horizons was discussed earlier. And then the GP is often required to have their own investment in the fund, so they have skin in the game. With respect to governance and LP protections, the three major protections I mentioned earlier, some mix of those is negotiated for. In a perfect world, you get all three, and you get them with cause and without cause. That very rarely happens. You get some subset of them. The Limited Partner Advisory Committee is a very helpful tool when it comes to governance. The committee is, by its very nature, intended to represent the interests of the limited partners. The investment restrictions and parameters that are drafted into the document go a long way towards governance by saying what the general partner can and cannot do with the money of the fund. And then in respect of transparency and monitoring, the traditional paths, and we'll get to some more modern approaches, the traditional paths were audited financial statements, quarterly, audited annual financial statements, quarterly and even monthly quarterly financials, monthly statements regarding portfolio developments. Capital call notices and distribution notices now contain more information than they have historically. Additional reporting requirements that any particular limited partner may need or require can be addressed in side letters. And has been already discussed a little bit earlier, ILPA's template fee and expense disclosure form, which a draft is already in existence and available. So I've identified some of the market terms that foster alignment, governance, and transparency, and Marte will now discuss some of the market terms that negatively impact these.
Thank you, Paul. So yeah, next, I guess I'll pause for a minute to say that the ILPA principles are aspirational. So they've set up these principles based on these concepts of alignment of interest, governance, and transparency. And there's a lot of terms in there that would move the needle a lot in getting comfort around all those issues. But it doesn't really necessarily reflect the market standard. They are aspirational. So what are some of the terms currently that negatively impact alignment, governance, and transparency? One is the complexity of the agreements. They typically run over 100 pages. They're exceedingly difficult to read and understand, even having practiced in this area for a long time. Opening up, I'd be lying if, I could say I'd open up a limited partnership agreement and truly understand the waterfall after a quick skim. That's just, it's not how, it's very complicated. On top of that, you'll have multiple funds within, a fund. So you have Fund X, and there might be an onshore vehicle, an offshore vehicle, all structured to minimize taxes for different investors. Then you might, during the life of the fund, form additional funds to meet regulatory concerns or to further avoid other taxation, and making sure that the agreements work as anticipated or as if they were just one large agreement with one carry, one management fee becomes very complicated, makes it difficult to monitor and enforce the legal terms and conditions. Another risk, management fees are very high. $10 billion fund at 1.5% management fee. If I'm doing the math right, I mean that's $100 to $150 million a year that the GP is earning for one fund. They might have multiple funds. I'm not sure how that compares to our operational budget here at CalPERS, but it's probably more. So this notion that management fees are budget-based, they keep the lights on, is not true. And everybody who's in private equity, has been in private equity, fully understands that. Fees, at least for the investment period of the fund, are based on committed capital. So the money that you don't necessarily even have your money at work. It's based on the committed capital. That's different than most of the investment industry, which is based on contributed capital. Moving on, even though those fees are so high and at some point sort of boggle the mind, the GPs are allowed to, that doesn't cover their partnership expenses of the fund, of running the fund. So legal costs, accounting costs, lots of other costs are defined as partnership expenses and billed to the fund, meaning it's on top of the management fee. And these are broadly defined, and over time, the GPs, especially now with the SEC scrutiny, are being more and more detailed and expansive about how they describe those costs, in part because the SEC is forcing them to be more transparent. On top of that, the managers can charge fees and do charge fees to portfolio companies. So again, rather than take certain expenses and utilize the management fee to pay for those travel costs, anything related to portfolio company, there's an attempt to shift that cost onto the portfolio company and away from the manager. The next slide talks about portfolio company fees. So this is a concept that has been focused on by the SEC and others, that on top of the other forms of income that the manager has, they can in exchange for performing certain services to portfolio companies, charge those portfolio companies fees for those services. Historically, those fees have partially offset management fees, meaning if there was a monitoring fee of $100, maybe 50 cents of it would be offset against management fees. Limited partners during the last cycle or two have really focused on monitoring and transaction fees as a type of fee that should be shared. More of it should be shared with the limited partners, and we have seen a trend towards larger offsets, up to 100% in recent limited partnership agreements. But at the same time, this is an area that the GBs continue to negotiate very heavily on, and there's other categories of fees that are not shared, and they've been very clear about that in recent fundraising. So we've gone from an environment where maybe LPs thought about 1 or 2 or 3 different types of fees and how those are going to be offset. A recent manager disclosed approximately 20 different types of fees, approximately half of which were shared or offset management fees 100%, and the others that didn't offset at all. So this continues to be an area that's highly negotiated. It's very complicated. I could probably spend the whole 20 minutes talking about the different ways in which fees don't get shared. For example, a fee, if a fund invests in a portfolio company alongside other investors, including affiliated investors like co-investment funds, it's possible that the percentage of the fee that was allocable to the co-investors wouldn't be shared at all, even if you had 100% offset. So there are many nuances like that that allow the general partners to keep those fees, and so this continues to be an area where there is a conflict, and because of that, the LPs are getting together and want to have much greater understanding of those fees and doing more diligence on those fees, and are requiring more transparency around those fees going forward. The next area that we'll discuss are management fee waivers. This is really a misnomer. This is basically a tax avoidance strategy from the GPs. We talked about how the management fees are not budget-based, a source of profit, and the management fee waiver mechanism allows, there's tax rules that if they do it right, it allows them to convert the management fee into a profit interest into the fund with the goal of avoiding, or minimizing taxes on those fees. So CalPERS still pays the money, but it doesn't go to management fees. It goes to this GP's profit interest. Typically, that is accounted for in the waterfall, and so the impact on CalPERS, generally is typically would be neutral, but is controversial practice, but one that persists in the industry. And with that, I'll turn it back over to Paul to discuss some other issues.
Sure. Some additional challenges, starting on slide 55, looking at alignment of interest and economics. In the United States, the economic waterfall is often what's referred to as a deal-by-deal waterfall. It is, in fact, most often a modified deal-by-deal waterfall, which requires that the general partner, the fund, return realized investments, the investment basis of realized investments as the first tier in the waterfall, then preferred return, and then some form of a GP catch-up, and then the split, which is often 80-20. And this differs from what has historically been referred to as the European-style waterfall, which basically says that if a fund had done multiple deals, just because there's been a disposition or exit in respect of any one deal doesn't mean you go straight to working your way through the waterfall. Instead, you have to return all of the limited partners investment at the first step before then getting to the later steps in the waterfall where the general partner can take its carried interest. So the nature of the U.S. deal-by-deal styled waterfall can create a little bit of a misalignment in that it creates clawback risks. So the good news is that these partnership agreements typically will include clawback mechanics that say when you get to the end of the life of the fund, if not sooner, and we'll talk about that in a minute, but when you get to the end of the life of the fund, we're going to do a reckoning and determine whether or not the general partner has in fact received in excess of what the overall deal is and should be. And if the answer is yes, then there's a clawback. Well, under the U.S.-style deal-by-deal waterfall, there's an increased risk that there will be such a clawback. And that creates clawback risk, meaning a number of things. The counterparty may not be able to return the money, but let's set that one aside for a minute. Even the nature of the clawback is in the industry drafted as an after-tax clawback obligation, meaning that if a GP received $1 million in carried interest and there was a clawback, the GP would only be obligated to give back the after-tax amount of those carried interest distributions at the max. So assuming a 45% tax rate, that means they would have to give back $650,000 at the most. So your risk in that scenario is if your clawback amount is above the $650,000, so let's say it was the full $1 million, the GP, at the end of the day, it was a break-even fund and they really shouldn't have gotten any carry, the LPs would look to the GP and say, you owe us $1 million in clawback, and the GP would say, well, yes, but it's calculated on an after-tax basis, so here's your $650,000. So that's clawback risk. The other aspect of clawback risk is that those taxes, those after-tax amounts, are based on assumed tax rates often. And this can vary a little bit from fund to fund, and it's because of there's a lot of arguments that GPs will give, but the most basic of which is that it's very complex because these entities are pass-through tax entities and the ultimate recipients of the carried interest are dispersed, and it'd be very difficult, and they would say impossible to sort of get a true dollar amount of how much has been paid in taxes to determine the after-tax amount. So instead, they use an assumed tax rate. Now, you will not be shocked to hear that the assumed tax rate is often the highest tax rate in jurisdictions that have the highest tax rates. So New York, California, et cetera. So there are some mitigating factors to help protect against clawback risk, and CalPERS pursues those. Guarantees from a parent entity that is fully capitalized that can cover the clawback amount in the event that the general partner cannot, or the individuals receiving the carry cannot. Escrow mechanics, putting some portion of the carry into an escrow until the end of the life of the fund and the ultimate reconciliation is done, is another mitigating factor. And then having the clawbacks occur prior to the end of the life of the fund, interim clawbacks as they're referred to, where you would do it either at the end of the investment period or annually, or some period that keeps the clawback risk from growing too great. As far as governance and LP protections, I think the important thing to note is that GPs are broadly indemnified and exculpated, meaning that generally, as a matter of contract, they are not going to be liable unless there's been gross negligence, willful misconduct, or fraud, which is a standard that differs from simple negligence or heightened prudent person standards or the like. In fact, many of these funds are domiciled in Delaware, and Delaware law permits drafting into agreements, either expressly or implicitly, the modification or waiver of state law fiduciary duties. And so some of the funds have come to market with express language that the four corners of the partnership agreement replace any such state law fiduciary duties. So this is a risk, and it removes one avenue of recourse for limited partners. Limited partners would still, of course, be able to sue for breach of for conduct that is willful misconduct, for conduct that is willful gross negligence or fraud, but not the state level fiduciary duty claims. And I think with that, I could go on again, but I think I'll hand it back over to Marte. Although I guess, do you have the clicker? I think we should cover some interesting things on 56 as well. So both 55 and 56 kind of run together. So I'm just going to keep going here, but we're nearing the end. Traditional LP protections are difficult to implement. So when I talked about removing the GP, terminating the fund, or stopping the investment activity by an LP vote, that takes coordination among the LPs. It often also requires a showing of cause, and that can require litigation. Sometimes the cause definitions themselves are phrased as a final, non-appealable determination of a court of competent jurisdiction that there has been, and then there'll be a list of bad things that they may or may not have done. And if they've done one of those things and you've gone and gotten that final determination of a court, then you can remove them or terminate the fund or in the investment period, as the particular agreement may provide. And on the other hand, with the standard of care that I mentioned, the gross negligence, the willful misconduct, and fraud, the difficulty there, of course, is that you have to be able to show that level of egregious behavior, and you have to be able to show the damages. And so a lot of times in complex financial arrangements, showing damages is difficult. In addition to the partnership agreement, I would be remiss if I didn't mention that another key document that is provided in the investment space in private equity funds is the private placement memorandum, which will contain in it a section many pages long of risks that vary from business risks to legal risks to regulatory exposure, et cetera.
Sorry, Ted, we probably went a little bit over, but with that, we can answer any questions.
We do. Dana?
Thank you very much. I so appreciate it. Just two questions, and one maybe somebody else is going to speak to it. But what is the current climate regarding SEC regulation, and what terms, if any, do you see that that would impact both pro and con?
Go ahead.
So I think the environment post Dodd-Frank and the requirement that the advisors to these private equity funds, which had historically not been required to register and now are required to register, has created an avenue for the SEC to pursue examinations, routine examinations, as well as investigations, giving them jurisdiction where they previously arguably did not have jurisdiction. So in that sense, I think the SEC is much more involved in private equity than they have historically and certainly pre-Dodd-Frank. I think the positive that's going to come out of that, and is already coming out of that, is GPs are now on notice and certainly warned that activities they may have felt were aggressive but not illegal, or aggressive but not a violation of the partnership agreement. Now the SEC has been very clear that those behaviors are not appropriate, and I think that that will, for those GPs that were engaging in those kinds of activities, I think that they would almost certainly stop. And then in terms of the documentation, the legal documentation, the amount of transparency being sought by limited partners is already immediately more robust. And Marte can speak to the nature of the side letter if you think it's appropriate. So.
Okay. And just one other quick question out of curiosity. When you say they take the highest tax rate, aren't these contracts typically subject to the jurisdiction of Delaware law?
They are, but the structures themselves are pass-through tax entities.
Got it.
Yeah, okay.
JJ?
Martel, I think you said that the GPs know what we've agreed to in LPAs with other GPs. And one of the things that we constantly hear is that these are confidential agreements. You can't expose them. Does that mean it's only confidential to non-GPs?
Well, in those situations where there's been an explicit, where I've been on the phone and somebody has said, "Hey, you agreed to this," I don't know what it's worth, but we've taken them to task about the confidential nature of that and elevated the issue. But I think it would be naive of us to think that that the GPs don't have that database doesn't exist, that what CalPERS has agreed to, and I think there's probably they're more aggressive about telling you exactly how much they know, but it's made clear that they understand what you've agreed to, and that's one of the dynamics in negotiating these agreements.
You've raised the issue of what we can't do because of antitrust. I have said more than once I'm probably the least risk adverse to the trustees. I quite frankly would welcome that lawsuit. But have we had anyone do some serious work on what is allowed?
Yes. So you can do joint purchasing agreements, and you can negotiate. You can share counsel. So one of the small things that I've done to encourage more collaboration is, if there's a commingled fund that I know's out there in the market that I've been requested to have outside legal counsel review, I start with the inquiry to the outside counsel, are you working on this for someone else? That'll keep our costs down and hopefully will encourage LP collaboration. CalPERS, I myself have spoken in front of ILPA on antitrust. ILPA has received antitrust advice from firms in our outside counsel pool. There are things that you can do. You can be up to, if you're less than 20% of a fund, you can explicitly have a joint arrangement to negotiate that deal. So there are things to do. We've advised ILPA and CalPERS on those. To date, there's been just people have chosen not to act on those opportunities.
Because I kind of would like to defend the lawsuit from the GP that says you're not letting us rip off the taxpayers enough.
I agree with that. The enforcement, I don't like to talk about enforcement risk as a lawyer, but I would hope that the enforcement risk would be low, but would not, advise you to violate the law in that respect.
And the other thing that I wanted to raise was when we've agreed that they are not fiduciaries, how do we as fiduciaries justify delegating investment decisions to non-fiduciaries?
Well, I think it's important. There is a standard of care that still applies to these managers, and we've attempted to negotiate the highest standard of care that we can. So though these managers might have a lesser standard than you and I have, even I'm indemnified for negligence under state law. So I think we have gotten comfortable putting our fiduciary hat on, that we've exercised a duty of care in reviewing and analyzing these agreements, and doing our best to explain the risks, the downside of risks to the business clients, and to weigh those risks against the upsides that were highlighted in the earlier presentations. So overall, I think we're satisfied that investing in private equity and investing in these structures does satisfy our fiduciary standard of care. On the aggregate, especially, it is always disappointing to see funds underperform and have pay for failure and that sort of thing, or bad acts be revealed and maybe not be able to do anything about it. But it's not unlike investing in public corporations in that way. There's often, there's pay for failure in that part of the market as well.
Okay, thank you.
Brian?
Thank you. Just two quick questions. The first one is, when you talked about most favored nations clauses with respect to what is in other LP side letters, so do we typically ask for copies of all side letters, and do we have access to that?
It can depend on fund. Sometimes our preferred position is get the actual side letter of the other investors. Sometimes you'll get a summary of it. So sometimes you do not get it. And there's some important limitations. There part of the whole divide and conquer sort of phenomenon, or observation, is that over time there's been more and more carve-outs or exceptions to the MFN. So, for example, the size of your investment. So, if we write very large checks, so we typically get the benefit of most other people's side letters, but there can be an exception for the amount of your commitment. So we'll get a special term based on our commitment. Others won't get that term because they're investing less. And this is, so we're in a situation where we can advance our own interests, but unfortunately it doesn't always advance the interests of the entire limited partner community.
Okay, then my second question is just based on your presentation. I feel kind of compelled to ask this. So either in terms of basis points or dollars, what's the typical legal cost to CalPERS in consummating one of these deals?
Yeah, I'd say approximate, it varies depending on the negotiations and how long they sort of get drawn out, or at what stage the counsel comes in. So for example, for a commingled fund, where we're, nothing trips us up, or we don't have, a month or two of negotiations, $35,000, $45,000 approximately. In private equity, if let's say we have a separate account, which we, have done more of, we might have a term sheet with the general partner that gets turned into a limited partnership agreement. And so there's more things to work out there. You're not just looking at the black line from the last deal. It could be 75,000, could turn out to be 100,000.
Yeah, that's an interesting segue, which is that customization is something we're seeing in the market. And so I think one of the reasons Marte asked me to be here was just because of our broad window into the market, representing 70 institutional investors and 18 public plans, et cetera. And one thing we are seeing is that the big players are looking for customization and saying to managers, we would like to enter an arrangement as the sole LP. And negotiate terms that we would like. And there's some managers that are open to that and some that aren't, but it is an interesting trend that we're seeing.
Okay, thank you, and thank you, Mark. Oh, Betty, I'm sorry. And that's why I said put it up so I wouldn't miss you. Right? I'm sorry.
Okay. Thank you, Mr. Chairman. I wanted to just clarify something. When you were speaking about joint purchasing agreements, I thought I heard you make reference to commingled funds. And are you equating that with co-investing?
No, so a joint purchasing agreement would be where multiple investors would get together in advance and announce to the general partner, specific general partner, or broader general partner community, say, hey, we're going to invest as one, and you're now dealing with not just CalPERS but CalSTRS or who.
If I might, it's essentially a joint venture.
Okay. Okay. All right. And then, go ahead.
Oh, no.
Did you have a comment? Okay. I wanted to also just see if anything took place after the recent SEC Blackstone settlement with respect to whether, were we invested in any of those funds at issue?
Yes.
Okay. And did the GPs communicate anything to the LPs after the settlement?
Yes.
Okay. And given that, I mean, do we have an opening there with respect to looking at using the settlement to pursue some of the common agreement terms that you discussed earlier?
Yeah, I mean, we've definitely taken a close look at it, and I think it helps us understand the practices in the market, especially some practices that maybe weren't as transparent as we would have liked. So it's impacting our negotiations in that way. In terms of anything Blackstone specific, I don't think I have anything to publicly comment
okay.
on.
But there are things that we probably avenues that have opened up for us in terms of the settlement.
We're definitely being much more diligent and trying to do it. And there's activities right now that you'll be briefed on soon about what we're doing to look more closely at some of these practices.
Okay.
With regard to specific managers, where we can discuss those specific managers.
The industry has definitely taken notice, and I think it's opened up a dialogue between LPs and GPs on a granular level that did not necessarily exist before then. That's my take on an industry-wide basis. And while I'm making an industry-wide point, to sort of end on sort of an up note, I would say that, CalPERS, from my vantage as outside counsel, engages in among the most robust legal due diligence process of any of the institutions we represent, large or small, and does really an exceptional job satisfying the duty of care.
And then just one last question. I mean, just given, and I really appreciate this presentation. It is, I think, much more grounded understanding about all the nuances with respect to how these agreements are structured. And I'm glad we have the treasurer here because he's actually really been aggressive about not only pushing the SEC, but also looking at state legislation. But the more I'm hearing about this, I guess I'm at a loss about what we could do as a state, but is there a shot at getting some uniform disclosure standards from the SEC? I know it's they're looking now at kind of enforcement as their biggest tool, but
well, it's an excellent question, Betty. I think the short term is that we want to see we want to approach it from an industry approach, and we'd like to see. This ILPA template, new and improved ILPA template is coming out in January. We're very hopeful that that gets adopted industry-wide, and then it can be improved upon. We're a little bit we're a little bit concerned about letting somebody else create the disclosure documents. So, but we certainly wouldn't rule that out as we go down the line, and see what kind of acceptance level of the template there is. And if it's not accepted well, then we would certainly think about pushing the SEC for more regulation.
Okay. All right. Thank you.
Okay, thank you for a very dynamic first part. And so we're going to break for lunch, and we will return at 1:45.